Ladies and gentlemen, I'd like to take this opportunity to greet you all and welcome you to yet another chapter that I'm about to start with right now. It's called an introduction to Forex trading strategies. The first question that is there is, what is a Forex trading strategy? For all of you guys who do not know or who does not know what is a Forex trading strategy, it's explained to you using the 4 following bullets. The first one says, a Forex trading strategy is a set of rules and analysis that a Forex trader uses to determine whether to buy or sell a currency pair at any given time. The second bullet point, it says, Forex trading strategies can be based on technical analysis, charting tools, or fundamental news-based events. So the main task of any Forex trading strategy is to minimize the impact of external factors on a Forex trader and to organize the trader's activities. There are probably as many Forex trading strategies as there are traders, but not all Forex strategies are created equally. So why is it important that you have your own Forex trading strategy? That is a question that I'm posing to you right now. Why is it so important? Why is it so essential? Why is it so crucial for one to actually have their own Forex trading strategy? So this is the answer to that question. A strategy is a set of rules. That is something that you must put in the back of your head. That a strategy is a set of rules. It helps a trader to avoid the destructive emotions during trading, but only if that trader follows the strategy without deviations. A strategy can be back tested on historical data so that you will have a proof that it really works. So it's very much important that you always back test to check if your strategy is useful or it's not. If it happens that you spot that your strategy is not working, that means you must change that particular strategy that you are using at that time and moment. Strategy reduces the time of the market analysis. So when you have a strategy, you reduce the time that you use when analyzing the market. That means you know what is it that you are looking for at a market or from the market at that particular time and moment. So as soon as the strategy provides a signal, a trader starts trading. When it doesn't, then the trader knows that he or she must not trade. So if a strategy provides a signal, it gives you an indication of when to enter. That's a time where you know that you should start trading. But if it doesn't, that's a time when you know that you must not trade, but you must just wait for a perfect set that is going to be accommodated by your strategy. It also helps a trader to be disciplined and to be more professional towards their trading. So if you have a strategy, you become more professional and be more disciplined with your whole entire Forex trading. So we're now going to do what? We're now going to be teaching you how to create your own strategy using the FX code approach. So the topic says learn to create your own strategy using the FX code approach, of course, because we are the FX codes. We're going to be teaching you how did we embark on a journey of creating our own strategy. So here are FX code steps that you can use to build your own strategy, your own Forex trading strategy. So the first point is that ask yourself what kind of a Forex trader you are. It's very much important for a person to ask themselves what kind of a Forex trader that I am. Because if you know that, it's going to be much more easier for you to actually start up a good strategy that accommodates you as an individual. Because we are all different. So we all have different ways of approaching the market. So let me just give a question that's going to guide you to know what kind of a Forex trader that you are. So we have a scalper trader. Those are people who get in and get out from a trade in very quickly. Like they do not waste time, just get in a trade and get out. Then we have a day trader, we have a medium term trader, then we also have a long term trader. Those are 3 different types or 4 different types of traders that we have. And secondly, it's important for you to choose a time frame that you prefer trading on. So we have 30 minutes, we have hourly, we have daily, we have weekly, monthly, etc. So that is also going to be helping you to know whether you are a swing trader or a scalper trader. So number 3, you have to decide which market condition you will focus on. As you know, there are three primary conditions that are there in the market. Namely, you have a trend, we have a range, and a breakout. So each of these conditions exhibits its own market tone. As a result, a strategy that is good for trend trading can show the weak results when the market is in a range. So that really makes sense over there. So continuing now for you to see, we're gonna go to number 4. Number 4 talks about you as a person. You must choose your tools. So you must ask yourself questions if you will use the technical indicators, and if so, which are those technical tools that you're gonna be using, or the technical indicators that you're gonna be using. It's important to note that there are two types of strategies which forex traders use. In most instances, the one with indicators and the one without indicators. So we have the strategies with indicators and strategies without indicators. But at FX Gold, we prefer strategies without indicators because we believe that indicators move after the market has moved, not that the indicators move the market. So if you prefer an indicator strategy, there are various technical indicators available in MetaTrader 4, which is the platform. That platform, it will help you identify the market's movement. No indicator strategy can include the analysis of candlestick patterns, chart patterns, trend lines, or other elements of price actions, as well as the news. Again, I think you heard that. Let me try to read it again for you. If you prefer an indicator strategy, there are various technical indicators available in MetaTrader platform, which will help you to identify the market's movement. No indicator strategies can include the analysis of candlesticks, patterns, the chart patterns, the trend lines, and other elements of price actions, as well as news trading. So number 5 is this point that is important for you to know as well. You need to be able to define the setup and the trigger of your strategy. So the setup are the required conditions, and the trigger means the entry rule. When do you enter, and what are the most required conditions for you to enter? So the setup is a favorable market condition, significant but not sufficient for opening a trade. It may refer to a particular location of candlesticks or indicators that you may apply to technical chart. The setup shows a favorable time for trading, but it does not point at the exact moment when you should start to enter a particular trade. So the setup may consist of one or more filters. Filters are designed to protect traders from receiving false trading signals. However, if you apply too many filters, you risk entirely missing trading signals. So a balance between a small and a large number of filters is necessary. The second important element is a trigger. As opposed to the setup, it is a technical signal that indicates the right moment for entering the market. Quite important to know your particular trigger to enter the market without any hesitation. So it can be candlesticks, the bar patterns, the indicators, and the escalators. The basic rule of trading is like this: risk not more than 1:2% of the deposit for one trade. So number 6, you need to choose the exit rules. Make a rule for take profit and stop loss orders, not only if there is an entry trigger, but an exit trigger as well. It is important when you understand that it is time to close your trade. The exit trigger is useful not only when you fail, but even when you have a profitable trade, because the market will not be on your side forever. So write down the rules of your strategy. It is important for you to journal down all the rules of your strategy and to journal your trades as well. Even if you are sure that you remember all the steps of your strategy, it is important to write them down, not to hesitate when it's time to trade. So number 8, which is the last point, you need to test your strategy on a demo account. Make a good effort. This will create a base for your success. If there are mistakes, you will be able to correct them without losing money. So after you have tested your strategies on a demo account, it is important that you then start using your strategy on a live account. Don't deviate away from the rules, but keep learning and thinking about how to make your strategy even better. So thank you very much, ladies and gentlemen.
Hi there everyone, this is FS Gojo Mentors. I want to welcome you guys to the main lesson of this entire course. What we're going to be doing now, we're going to be focusing on learning how to master your entry point. Meaning, in this lesson guys, you're going to be using pure price action in order to help you understand the mastery of entries. Now, you're going to understand that when we cover this lesson, we're going to start with the theory first, and then later we're going to cover the practical side on how to actually enter your trades. Now, without wasting any further time, let's continue. How to find good entry points. You're going to see that finding perfect entries is basically working on your entry points. So we need to use lower time frames in order to find good entry points. This is from 1 minute up to 30 minutes charts. The reason we are using smaller time frames is because we need to actually see what the market is forming in its earliest forms. So this can actually help us a lot if you're going to be entering your trades. Secondly, focus on finding good entry points. This can help you find high probability setups. It requires analysis and waiting for a setup to form before you can actually enter your trade. Now, the best entry point also goes hand in hand with the time frame that suits your personality. Even though I did mention that we're going to be using 1 minute up to 30 minutes charts, there are going to be others who are going to be using time frames such as 1 hour up to 4 hours chart. 1 minute up to 30 minutes charts also goes hand in hand with your personality. It requires that you become more of a scalper than a swinger. So let me show you what I mean by that. As you can see here guys, what we can have here is the market moving in this manner, right? I would say this market is moving like this in a more of a daily to 4 hour and 1 hour chart, right? So when the market moves in this manner, a swing trader will be trying to take the trades from the top and the bottom, as you guys can see. So if I'm a swinger, I'm going to be entering trades around these levels. As you can see, I'm hoping to take the entire trade as I am looking at the swing perspective. You can see that a swing trader is in a way taking less trades than a scalper, because a scalper will take this trade and trades inside as well. That's a scalp trader. You're going to take trades and a lot of trades inside. Don't look at just the swing, but you're also looking at maximizing those small trades. So the difference between a swinger and a scalper is also the trades they take. A scalper takes more trades than a swinger. As a swinger, you're going to need to be as patient as you can possibly be. Now, let's continue with the lesson. Market structures, trends, and zones. In our course, you will learn about market structures, trends, and zones. Those are the 3 tools you need to master entries using price action. Market structure lessons will be covered in detail on FS Gold Advanced New Market Strategy videos. Now, trends. You're going to see that guys, in order to make good market predictions, you need to outline 3 types of trends that you need to know. We have an uptrend, we have a downtrend, and we have a sideways trend. This includes understanding support and resistance levels, of which I already covered in the technical lesson part 1. Now, in order to find good entries, it is best to trade with trends. In order to find good entries, it is best to trade with trends. To effectively use trends for entries, you must learn how to integrate zones, trends, and significant levels. You're going to see that we're going to help you guys in order to understand the difference between each and how to actually integrate all these 3 tools. The lesson on how to use and identify trends is already covered in technical lesson part 1. Now, you're going to learn on how to use zones and significant levels in order to find good entry points. Significant levels and zones. In order to find significant levels, we are going to use the FS Gold high and low strategy. Secondly, FS Gold zone strategy, you need to learn on how to identify the difference between buy zones and sell zones. Key points: the end or break of an uptrending support is the beginning of a new resistance, or vice versa. Let me explain what I mean by this. So what I mean by that is, if the market here is acting as a support structure, as you can see at this level here, the market has a very strong support. So if you have a support structure and the market breaks below a support, it will then become a resistance, because now the market will be resisting that level. I hope you guys can understand. Vice versa is also true. If the market is resisting at this level, we can see that the market is resisting at its current level. Should it break, that the resistance will then become a support. This can help you a lot in order for you to understand how the zones strategy work. So let me show you how the zones strategy actually works. So as you can see here, guys, we basically have two different types of zones at this time and moment. You can see that the market is buying at this point. It's hitting the top and the bottom, the top and the bottom, the top and the bottom. The market is basically ranging inside these tools. So as you can see here, guys, the market here is acting more of a support structure. We might call this level a level of support. As you can see here, guys, the market is failing to push below, which becomes our support. This is of course an uptrending support. The market is failing to break below this support. Should the market break here, we're going to expect a reversal and a push towards the downside. Equally opposite, should the market fail to push above this structure, it's going to be acting as a downtrending resistance, right? Should it cross, it's going to act more of a support and expecting a push up. As you can see, if we're still in here, this is known as a buy zone and this is known as a sell zone. We break outside the sell zone, we're going to look for a buy. We break outside a buy zone, we're going to look for sells. Now, remember, a powerful forex trading strategy doesn't have to be a complex one. Keep it simple and follow all its rules. So guys, now let me give you a bonus strategy that you're going to be using as well. This strategy also goes hand in hand with understanding zones. So as you guys can see, we've explained zones for you. We know that when the market is still pushing up here, we are inside a buy zone. We are failing to break outside this support structure. Should it break the support structure, it will become a resistance, right? We are still in the buy zone. The market is still buying. So now when we cross outside this structure, we expect the market to retest before we look for a sell towards the downside. So the market is breaking outside the support, it will then become a resistance, as you can see, and expecting a push towards the downside. So now a trick that I want to share with you guys: should the market break and show you confirmation of the market breaking, you can expect the drop to be as low as where the market actually started. So you're gonna see, guys, this is also one of the market tricks that we use for us to actually continue with a break of a trend. Once the market breaks, we're actually gonna expect the market to push below. So as you can see, guys, these are some of the tricks that you're going to be using. Currently, always make sure that you stick to your trading rules and don't let the market play you. You're going to see that most of the time, guys, the market will give you a perfect entry. Let's say, for example, you can see that the market is forming and it's giving you some sort of a nice entry here. So what the market does and how it likes to operate is that you're going to see that at this time and moment, you're going to be expecting the market to give you some formation, and we're seeing a break towards the upside. The market has now given you a perfect entry, and you're seeing opportunities of actually pushing towards the upside. When you see these opportunities form, when you see the market giving you an entry point, you must know that once you see it, you must be patient, because now the market will test you and will test your ability of trusting in your own setup. The market can even react like this. The market can push down, push up, push down, push up, give you some volatility until it actually pushes towards your direction. As you can see, the time it took to complete the setup was not as you have exactly predicted. You cannot predict on how fast the market will move, as that would depend on volatility. The only thing you need to understand is being able to actually get the direction of the market. The only time we actually analyze is trying to understand the direction of the market, and you're going to see that most of the time your biggest drawdown will become one of your biggest wins. Meaning that, let's say for example, I am looking at a buy trend and we're trying to go for sellers, and the market is still pushing up and down, pushing up and down, pushing up and down, pushing up and down, and it breaks below. We're looking for sales. We're looking for the market to actually reverse. So the market can give you a reversal of a sell and still push up to test, to actually trade other traders, to actually see how long are you going to stick to your decision until it actually continues with your sell towards your downside. Remember, if you enter your sales here, this is going to be in a loss. You're going to see sometimes one of your biggest losses will become one of your biggest wins. It mostly happens in the Forex industry, as the market also trades traders. You're going to see that as long as you've seen your entry, you need to be able to trust in your analysis and stick to the market moves. So now let's continue with the lesson. What makes finding good entries difficult? You're going to see that the only thing that makes entries difficult is manipulations, right? Manipulations comes in different forms. We have fake outs, we have traps, we have stop loss hunts, and volatile market consolidation. You're going to understand how to spot all these things in the market once you continue with the lesson. Now, different market conditions. We're going to have choppy market. This refers to a market condition where prices swing up and down either in short term or for an extended period of time. A choppy market is often associated with the rectangle chart patterns or volatile periods where a trend is not present or the trend is difficult to trade. I'm going to show you guys examples of a choppy market, but mostly a choppy market is when the market sells at a support and buys at a resistance. You're going to see, once you go to the chart, you're going to be able to see this even clearly. But before we even go there, I need you guys to actually understand what I am talking about here. So you're going to see, guys, during choppy weeks, you're going to see that you're going to be at a support, expecting a buy, the market will be selling. When you get to a resistance and expecting a sell, the market will be buying. This is just a choppy market. The market is spiking up and down. It's known as a form of manipulations. The opposite is also true. When you're expecting the market to actually resist, it's going to push up. When you're expecting the market to actually support, it's going to push below. You're going to see the market is not respecting any setup. It's going to basically do whatever it wants to do, and there's no any clear indication of what the market is trying to achieve. That is just only when the market is trying to actually make other traders lose a lot of money. So when you see that you're in a choppy week, try to avoid trading, as there's time to trade and there's time not to trade. Now, trending markets. When looking at a trending market, this refers to a market that respects normal market setups and trend setups. This is the kind of market that we are all looking for. We usually trade trending market. So as we showed you guys, we're going to be using trends and trends most often. So meaning that we are the type of people who actually trade a lot of trends. It can be small trends, it can be big trends, and it can be long trends as well. It can be trends in trends, guys. This is what we usually trade, right? So I'm going to show you also in market moves. You're going to see that usually we're going to be trading that kind of things, kind of trends and trends, and so on and so forth. You can see, guys, this kind of market consolidation actually work a lot if the market is, of course, in a trending market. So that's how we get to benefit if we're going to be trading in trends. So you're going to see that the market will be respecting our setups, and you're going to be making most of the money when the market is in a trending week. These are just examples of how the market moves and how we use these trends in order to achieve high probability trading setups, right? We need to find these trading setups in order to actually have a high winning streak. So now, how to avoid losing because of manipulations and different market conditions. Manipulations is when the market takes you out of a trade due to manipulations. Stop trading and only wait once the market settles down. As I told you guys, there is time to trade and there's time not to trade. Choppy markets, we have already talked about how to define a trend. So by now, you should have no trouble deciding if there's an uptrend, downtrend, or no trend. So what you can do when you're confronted with a choppy market, you must make sure that you actually avoid trading for that week. Don't trade. There's no need to force a trade if you don't have a good chance of winning. So If you can fight the edge of trading, then trade on a demo account until the market is back to its normal trading conditions. And B, please pay attention that you must have patience when you're in a trade by placing a stop loss or a take profit. So now guys, how to win using FS Gold strategies. Start trading on a demo account to identify which of the FS Gold strategies works best for you. Due to different personalities and risk appetite, your trading style might differ from other traders. However, you have to take more than 100 to 1,000 trades in order to effectively diagnose your trading style of your system. You have to continue trading using each of our strategies until your edge actually kicks in, meaning that you can't say that no strategy works for you, whereas you haven't even tried. In order for you to know which strategy works, you need to put in all the efforts, and you need to also try more than 100 times in order for you to understand which one works best for you. Now, when your edge kicks in, you'll find that you have a good trading system that works sometimes. Make sure that you don't give up on it. Instead, identify the forex market types it performs well in and only trade those. So when it works sometimes, it means it's working in a certain market conditions. It could be working in trending markets, or your strategy can also be working in a choppy market. That's when you're trading against the trend. So in order for you to trade against the trend, you need to trade against the trend in a choppy week, but in a trending week, you need to trade with the trend. You need to build a toolkit of FS Gold strategies that performs well in different market conditions. Like I said, if you're going to be trading against the market, you're going to need to trade that in a choppy week. And if you're going to be trading with trends with the market, you need to trend within a trending week. So basically, you need to use your toolkits or strategies as appropriate and depending on the market type that you're in. Also know that, guys, if you're a beginner or intermediate trader, don't force to learn all strategies at once. Rather, use this approach. Make rules for the strategies that you choose to use so that if you want to trade, only trade one market conditions it works better in. So you need to know which market condition you want to trade in. You want to trade choppy weeks, or you want to trade trending weeks. Find good setups, enter your trades, and wait to see how the market plays out. So now guys, we have covered the theory of what we're actually going to cover in the next practical lesson. I hope you guys are ready. Stay tuned as we actually approach the market in a more practical side. Welcome to the practical side of Mastery of Entries Part 1. So what we need to look at first is the time frames that we are going to look into. As you guys can see, here we have our 1 minute time frame. Here we have our 5 minutes time frame. Here we have our 15, we have our 30, 1 hour time frame, 2 hour, 4 hour daily, so on and so forth. So right now, currently, we are looking at XAU USD. As you can see, guys, we are going to be analyzing this and spotting trends and traps in order to help you guys see how we actually get to have our entry points, how to spot when to trade and when not to trade. We're going to be covering such that we've been discussing: trending weeks, choppy weeks, manipulations, so on and so forth. So first things first, you can see that the market doesn't give us much here, so that you know that how to enter your trades. Now let's see in terms of how to actually continue where we are currently. As you can see, if I will try to analyze, I'll try to go to daily charts and see what the market is doing. You can see that the market is giving me some form of a clear strong rejection here, so I don't have a lot to do. I can just basically come here and make this as a form of resistance. The market is not giving me much to use, so I'm going to wait for it to give me more details in order for me to continue. So I can go to 15-minute charts and see what the market is doing clearly. I can see if I go in here, that the market is of course trying to push above, so I can come here and do for myself some sort of a resistance zone. You can see here the market is trying to resist, so I can mark this as my zone and wait it out and see what more I can do in this point. I can go to 5 minutes as well and see what the market is doing. I'm seeing that there's possibilities of a trend, right? You can take trends in the 5 minutes as well. So how I like to do trends and how I like to advise you as an entry trigger is to have your trends doubled like this, where there's most touches, and basically be able to predict the possibility of trend. The trend might not work, but I want you guys to actually start practicing this manner of approach. Your ability to actually to use trends for entries will be one of the most powerful tools you need as a trader. Now we're going to wait it out and see how the market plays out. All right, you can see that the market is breaking below this trend. Should it break, we need to let it continue and see how far it can continue with this trend. All right, currently we're getting some information here. You can see that we can actually form a trend with the information that we're getting here. You can see now we can form a more stronger trend. You can see that the trend that is represented by itself here will be like so. I'm going to take touches from below and now come and rectify this. But you must start to continue. Don't try to be perfect, and you can let a strategy be as simple as it can possibly be. So now, since our trend is forming, the break to its side will form our direction, meaning that should the market break above, we're going to continue with continuations to the top. Should it break below, we're going to look for continuations to the bottom. So let's see how the market plays out. Looks like the market broke below. As you can see, the further push towards the downside. So you have to know that, guys, usually when the market breaks below, it can continue towards the bottom like so. But there's a trick to that. You can see here we have some sort of support. So meaning that when the market actually breaks out below and finishes the break, we expect some reversals. Let me actually go into a more practical side and actually show you what I mean by that. Let's say, for example, we have some sort of a bullish pattern. The market is pushing above like so. The market is in a bullish trend and it breaks below. Retest. Because the market started here, or you look at the previous resistance from behind, you're going to see that it could be from behind. After it actually breaks out of this trend, we expect some sort of reversals. Whenever the market actually breaks out and pushes below, we're going to look at the start of the trend or the previous resistance from the market to actually look at some sort of reversals. This strategy usually works. Even though you can continue the breakout, you can also look for a right angle triangle reversal. It can exactly be a right angle triangle, or it can be lower than that before seeing some reversal patterns. That's just some of the tricks that you might use once you are a trader. So at this point, I might expect some reversals, but we're going to see how the market plays out from here. As you guys can see, the market is reversing quite nicely. So now what we can do is we can go back to at least an hour chart and get to see what the market is doing and see what kind of formations we can do. We can see that this one already did not take place, so we can remove that, and the market has already took part here. We can remove these things from our chart, right? We need to have our chart as clean as possible so you can see what to expect. So you have to know that, guys, with trends you have to try. Now I'm gonna try and see what I can do. So what you need to learn about trends, guys, is that even though they're not gonna always help you actually giving you 100% trades, but you need to put them on and only enter the ones that you are confident in. But you need to practice trends. You need to practice the ability to be able to predict the next price, right? Because you're gonna see that with every strategy that you're gonna use, your only possibility, your only edge is the ability to predict the next price movement. So practice that and your edge will start to kick in. Now let's see what the market gives us in order for us to continue. So now let me go to at least 30-minute charts and see how the market is going to play out. All right, you can see that the market is respecting this setup here. I can see this resistance is strong, and I can see that I can also adjust my trend as well. I can adjust this trend and see how the market plays out. However, if the market is playing at a resistance like this, possibilities are we are in a choppy week. You can see that there is no actually clear direction. The market is just playing around. So let's see what more can give us. Now I'm just gonna let this one like this. Maybe we might change it later, but let's see how the market is doing before we can actually continue. At this time moment, the market might push above or play around this level. Let's just see how that actually plays out. So you guys can see what I'm seeing here is possibilities of a new trend forming. However, the market is not spiking up or down. It's basically trying to form some sort of a rectangle. This is known as some of the choppy wicks movement. The market is not pushing up or below. It's just consolidating. It's what we call a market consolidation. It's just part of manipulations that you're going to be able to understand, that you only enter once it's done. You're going to wait until it breaks above or below any possible trends that you're going to form. You're going to wait for the consolidation to end before you can continue with some volatility towards that certain direction. So I hope I don't confuse you guys. Let's just continue. Maybe I can explain after the market played out what I meant by that. This is the kind of trends that are hard to trade, right? This kind of trends, we can actually call them manipulations, right? This kind of trends are the trends that are hard to trade. Try not to trade these trends because these trends are only there to help us spot the next direction. We use these trends to actually spot what the market can do. So what I'm trying to teach you here, guys, is your ability to understand how the market moves. The market moves in a way that you need to understand price. We use these tools in order to know what the market can do next. When I see these things forming, I know this is a trend that's not supposed to be traded. These moves are just too small for you to actually profit a lot. So you're going to wait for the big moves like this kind of moves, for you to profit from a trade. Okay, what I'm seeing here is the market is trying to break above. The market is trying to break above this consolidation trend. What we can do is to also try to modify our trend, right? If I go to 1 hour chart, I can see that a nice trend is forming there. And if we trade with trends, you need to know that your trends needs to be updated to see the next possibilities, right? Now let me see if the market can be favorable or not. So if I'm going to be updating my trend at the bottom, I also need to update my trend at the top. So I'm going to just put it like so and let it be in this manner. Let's see what more can the market give us. Also bear in mind that is a very strong level. The market is struggling here. You can see how high the market is struggling at this level, guys. You can all see that. So it is also a nice level that we need to pay attention to. So I can go to 30-minute charts and continue with the market movements and see how it plays out. As you can see, guys, this was easy to spot. The trend just formed for me a nice buy momentum, right? I can see that this is a nice strong push towards the upside, but we also need to know where to exit. So for that, I can go to 1 hour chart and see the next possibilities. So guys, remember I told you guys we're also going to be using FX gold high and low strategy. So we need to spot levels where the market might reverse. These are such levels that we need to be careful of. You can see this is the market levels that we need to be careful about. These are market levels that we need to know. We can see we've crossed above this level and we're approaching that level, right? So there's a difference between levels and support and resistance. That lesson will be covered more in depth in the next following lessons. For now, what you can understand is that we're going to use support and resistance to actually cover zones, as zones cover the ability to understand that there could be possible reversals here, and levels is levels where we see as key market areas. These are key chart levels. I can see here this is a key chart level. It's not more of a zone but a chart level, right? Zones is where I'm expecting the market to actually not do a simple reversal, right? It's more of a zone than a level. You can see here it's more of a level, here it's more of a zone. However, we're going to cover that more in depth in Master of Entries Part 2. So now let's continue with the market and see what we can do. At the moment, I'm expecting the market to actually hit here and see if we can complete our chart movement. I can see we have our uptrend here. Let's see how the market actually plays out. I'm going to go 30-minute charts and let's see what more can the market give us. Okay, we can see that here, guys, that formation of ours actually took place. If it was a trade you're gonna take, you would have seen that here we had some sort of an uptrending support. Hope you guys can see. Unfortunately, this is a trade that I didn't catch. However, it's also a nice lesson that I want to give to you guys. I'm gonna now start taking trades from this point. I was just analyzing and seeing how this one actually operates, and it respects the strategies that we give you guys. What did I tell you before? Once the market breaks outside an uptrending support, we're gonna expect a breakout after more of a reversal, right? I said after we've seen that right angle triangle strategy, we're gonna expect some sort of reversals. As you guys can see, the reversals already took place, but you can see how effective the strategy is, and you can use it from 5 minutes as chart. You see, I told you guys for entries you can use 5 minutes or 1 minute. Even for 5 minutes, you can see you could have seen it more clearly. It's only a pity I missed this trade. However, those who could enter, those who already knew how to apply the strategy, would have caught this trade easily. Quite nice. You can see this was also a nice trade to spot. After this trade, we're expecting a reversal. So now let's go to the 30-minute charts and see what else can the market do and how to profit from the market. Okay guys, coming here, what I can tell you is after this right angle triangle and the market is failing to push above, I'm gonna let it play out until we continue. You don't have to always trade. You're only gonna take trades that you see. At this moment, the only trades that I saw is this trade. Also, this one you could have seen it if you're gonna go deeper as to 1 minute or 5 minutes charts, but you don't have to trade every time. As you can see, you can have a trading instrument that you look into, but you don't have to trade every single move. If it doesn't give you an entry point, you don't have to trade. For example, for analysis levels, I can see that the market can actually drop here, can push below, it can touch the top here before expecting some pushes towards the downside. However, seeing an analysis and an entry is two different things. If you've seen analysis that you want to play in a certain manner, you don't have to enter all the time. You just have to wait it out and wait for an entry that you would take. So don't force entries upon the market. You have to wait it out until you find an entry you're going to be confident into when you enter. As you can see here, we hit the bottom here. So let's see how the market continues. Okay, first level here, I'm seeing the market breaking outside the structure. So I'm going to expect some sort of reversal, either a retest and a push below. Once we are outside this trend, I want to see what more can the market do. Just trying to actually adjust and see if this can be sort of a retest and a push below, or what it can be from this level. Now, for now, I can see that we are outside this bullish trend. We're in this bullish trend, but we've pushed below even the lowest point. So let's see how that one actually plays out. As you guys can see, this is forming for us some sort of confirmation that the market might push below. So this is more of a chance for you to know that the market might be pushing towards the downside, guys. The market might be pushing below. Possibilities are there. I'm looking for the market to push below. It is outside this trend, and expecting the market to actually push below from this point. Let's see how the market actually plays out from here. We are back again, guys. You can see that the market is consolidating. Even though you might enter the sell, you're gonna see sometimes the market might make you wait the longest, right? The market actually make you wait. We can see that it's failing to push below. You can go to as little as 15-minute charts and see what else we can see. We can see that the market here is forming a bit of a trend, so we're gonna wait it out and see how else to profit from this. We can actually profit from this, but when the market consolidate, it's usually a confirmation that something major might come. Something major might come. You can see here the market is in some sort of a consolidation. You can see a consolidation is also a bit hard to profit because the market is consolidating. As you guys can see, the market is actually consolidating in here. It's been pushing up and low, up and low, up and low, and you can see that's consolidating, and the break below will indicate a push towards the downside, and the push above will of course indicate a push towards the upside. Now at this moment, I'm seeing this is still being valid because we're still under this strong resistance here. We can see here at this moment that the market is actually forming a trend. So this for me is indicating that the market might have reached the low. So if I enter a sell here, I would exit at this level here, because this is also a level we can pay attention to. As you guys can see from here, this is a nice level we can pay attention to, and this one as well is a nice level we can pay attention to. So this one is deemed invalid. We're going to continue with this, guys, and see how many trades we can actually check. And from now, I'm going to be spotting where I'm going to enter and where I'm going to exit, and see if we're going to be taking more wins or losses. But firstly, I'll just show you guys how the market moves and how your analysis can actually make you wait. Now we're going to go deeper into actually entering trades. So at this time moment, I can see that the market might be forming for me some sort of a trend here. So let's see how that trend actually plays out. So I'm going to tell you where I enter and where I choose not to enter. I want to go to 15 minutes charts and see how else I can profit from this. I can see that the market here is hitting a resistance. So for me, I'm waiting for a market to push below and see if I can catch the sell towards this low or a push towards the upside. For me, I'm just looking at the candlesticks and I want to go for my sell. So this is my sell trade. Let's see how it plays out. If I lose it, it's going to be my first loss. If I win, it's going to be my first win. I'm going to keep track as well. Let me just put it here for safety reasons. My profit is higher than my stop loss. Let's see how it plays out. It actually took me out and then shot below. This is known as manipulations. As you can see, the market can actually stop loss hunt when it gives you a nice setup. Anyway, what we can look this at is the market actually took two decisions, right? We can see that we're in a consolidation. That's point one. And then outside this trend, this can be seen as a retest, push up, and reversal, of which in a way it was not actually a good trade to take, depending on whether you actually check your fundamentals. So you have to also make sure that you look into news. A fundamentals clause is going to be open and well in our course, so make sure you check that out as well. So at this point here, guys, don't be stressed when you see this. Even though it could have went against you or it could have went in your favor, you could have still hit my TP. However, because it's manipulations, you don't take it personally. You took a first loss. This is our first losing trade. Let's see how else we can continue with the market, right? We took our loss. Now let's see what else we can do. I'm teaching you guys the real trading. This is the real things that happen in the market. Don't expect trading to be an easy road. Expect it to be challenging at some point. However, you're gonna see that when you actually trade a certain pair and get to understand how it operates, you're gonna get to profit more. So now let's continue and see how we can continue from here on forth. So what I need to do now, I can go to 30-minute charts or 1 hour chart and see what else is the market giving me. I'm gonna go to 1 hour chart and get to analyze what is the market telling me and how to continue from this point on forth. At this time moment, guys, what I'm seeing here is possibilities of the market pushing above, right? You can see here we're in a bullish trend, but now we're gonna wait and see if we can push above. So from this point here, you can see that the market is pushing above this level. So I'm gonna take this as a buy trade, right? You have to know that even though the market might be difficult to trade, you can respect the market, but you don't need to fear the market. Remember, guys, you can respect, but for respect, you don't have to fear. You respect, but you don't fear the market. Always remember that. Looks like this is our winning trade, guys. Let me just adjust this correctly. As you can see, we had to wait out the market for this long. So now we took a profit, guys. You can see the loss is small, the profit is bigger, and the market was consolidating a lot. At some point there, I thought we might hit a stop loss. However, we haven't even reached our stop zone. This is our stop zone. This is our exit level, and we profited from this trade. You can see that even though you might respect the market, it doesn't mean you have to fear it. The market can do such moves, right? This is just a learning curve. When the market takes you out with a loss, it's just helping you to get to be able to be confident enough to continue. So now we have one win and we have one loss. Let's see what more we can do. So at this point, guys, I'm seeing some sort of a resistance here. I don't know if you guys can see that. This can be seen as some sort of resistance here. However, I don't have enough data but I can use this as some sort of a resistance of some sort. So I don't know how I can place this. You can see that, guys, analyzing has to be some sort of a task. But for now, those are possibilities. I'm going to remove this for now and see if the market can actually give me more information before I can actually continue. So now let's see any form of entry forming before we can actually enter. Right, you can see here it was a push above this structure and we went for a continuation towards the upside. Of course, we are out of this trade, as you guys know, out of a trade, which means the market to actually push above. So now I'm coming back here. Now I'm trying to analyze what else is the market doing. You can see here we have some sort of an uptrend, right? I'll try not to remove the analysis from the past, just to have a clear view of what happened. But at this point, the market is giving us some information to use. We're getting some data, and when we get some data, we're getting some possibilities of trades as well. So let's see if the market can respect our setup, right? Since these are possibilities, let's see how the market plays out. We are breaking below, guys. We are breaking below. If you look closely here, we are breaking below, guys. We are breaking below. The market can still try to stop loss hunt. So if you see a market condition for me like this, you can take a trade. So I want to take my trade, guys. The market is breaking below. I want to go for a sell here. I expect the bigger sell as this trend is a lot bigger, and I want to expect my stop loss to be a bit big as well, because I want to be flexible with the market. Let's see how it plays out. Take profit, guys. This is our second trade and we are out with the win. Obviously I tried to push my stop loss a bit higher because the possibilities where the market can still push to actually try to retest this level here, right? Possibilities were there that the market can come to retest this level, so I'm trying to push above to see that if it comes here, it's going to obviously be a push, a normal push towards the upside, guys. The reason I wanted to push it above there is if the market actually were able to reach this level, it's going to be a buy. It's going to be a continuation of this buy trend. However, if it's still going to reverse here, I will still say it can be a sell and a stop loss hunt of some sort. But if it reaches this level, it was going to be a buy. But I went for a sell and we are now in profits. This was first loss. This were our take profits. So as you can see, guys, possibilities were there. We can see that this was forming some sort of a nice trend, and trends are very important to find, guys. Trends are very important to find. We see this does not take place. Now we're gonna wait it out and see how the market continues from this point on forth, and see what else we can do to get to profit from the market. The market has continued to push below. Let's go to 30 minutes charts. Just push it to this level and get to see what else we can do. You can go to as little as 15 minutes charts and see what else is the market doing. It's 1 hour. I'm seeing that it does not give me a lot of information. However, you can see that the market is trying to move. You can see that this bit of a trend is formulating for us a push towards the downside. We are as well at a resistance that is rejecting here. So should it cross below, I'm going to look for a further push towards the downside. And if it crosses above, I'm going to look for a further push towards the upside. So what I can do is try to do some sort of a trend here. I hope having all this green stuff on my screen doesn't actually disturb you guys, but I'm just trying to give you a real trading experience. I'm just trying to give you a real trading experience. This is just a practicality, guys. It's not meant to actually entertain you. It's for you to understand how the market operates and how trading is like. Those who trade smaller time frames, guys, let's say 5 minutes charts, you can profit from such things. You can profit from such trends, because it looks like this trading instruments does respect the trends. You can profit from here to here, from here to there, as you guys can see. So me, I like to go 30 minutes charts and see how it continues from this point on forth. As you can see, guys, it's still respecting trends and trends. I'm just gonna adjust this a bit, because I told you guys we use this to actually spot strong trends, right? So you can see there was a strong trend. Let's see what else is the market doing. It's respecting our trend. However, it's showing us that it's trying to consolidate more towards this level. So let's see what else is the market going to do. So at this point, guys, you can see that the market is actually consolidating. This can be seen as a push consolidation and a continuation, or a push consolidation and a push above. However, what we can do is wait it out. Let's see what else can the market give us. Okay, you can see, guys, the market is trying to push below. The market is trying to push below. We do have a trend here. We do have a trend here. You can see our trend but the market is pushing below, guys. You can see the consolidation is towards the bottom. Let's see how further the market plays out. Okay, for me, guys, this is more of a consolidation. Now, if I were to enter a trade here, I need to know also where to exit. So I'm going to have two possibilities. Usually when I like to do a trend, I like to complete the trend. So the trend has two possibilities for me. Let me see. This is the top. This might be the bottom, right? Or I don't like to usually use one spike, so I'm going to look for a place where it has more spikes, guys. This is just possibilities. Just want to see if I can put this here as well, right? Because we have a very strong resistance here. I don't think if we're going to have a sell, the market can cross below this one. I'm not sure, but possibilities are there. If it crosses below or something like that, it can go there. And if it pushes above, we have our top there. So we need to have a bottom and our top. You can see this is our top, and this can be seen as our bottom. So what I can do for now is change the colors to red and a bit thicker, and this one as well, can make it red. So at this time moment, what I see is the market consolidating. I want it to break below to know that I'm going below. I want it to break above to know if I'm going at the top. So now let's see what can the market give us. It's breaking below, guys. It's breaking below. I'm gonna take my sell trade. Should it cross above, for me, it's gonna confirm a push towards the upside. So I'm gonna have my stop loss where I deem my analysis incorrect, right? My stop loss doesn't actually cater for how much I'm gonna lose, but where I'm gonna be incorrect. If the market crosses this level here, for me, it's gonna form a buy if it crosses this level. So that's where my stop loss is gonna be, and my take profit will be nearly around this level. So let's see how that actually plays out. Okay, looks like we are in our stop loss region. I might take a loss, guys. The market might be reversing as it's respecting the trends here. I might have entered too quickly, but we're gonna see. Almost took me out few seconds. Let's see what happens. Might be a bad trade, but at this point I'm rethinking my trade. Possibilities are this is a breakout side and a push above. I'm rethinking my trade, guys. I'm rethinking my trade. I can close in losses, already hit stop loss, or I can wait it out and see what the market further decides. The market is the king. We cannot force direction. Let's see how the market plays out. It took me out, guys. It took me out. I took a loss. I took a loss, guys. We have one win, we have two wins, we have two losses. So let's continue and see how the market plays out. What did I say? Should the market cross above this level, we are gonna see a push towards the upside. That is the truth. You see, I don't have to be in this trade. I don't have to hold the losses for long to know that this wasn't gonna work. So should I cross above here, we expected what? We expected a push towards the upside. As you guys can see, the market actually pushed above, and at this time moment, we're gonna see how else the market actually continues. Okay, now how we're looking at this, we can see that we hit the top 1, 2, 3. So I'm gonna look for some push towards the downside that are gonna be present in this manner. Possibilities are there. You just have to wait it out and see how the market actually plays out. So for me, I can have a pending order, meaning that once it reaches level, the order will open. It will only open when I hit here. So if that hits, I'm gonna expect the push towards the upside, towards this level, more or less, right? This was my loss. You can see my take profit always bigger than my losses. So this is my loss, this is my loss. However, my profits are bigger. So in overall, I'm also like still in profits. So we'll see how that plays out. So I'm gonna put my stop loss a bit higher, because should we reach here, it'll be wrong. Because it's high and low, I'm gonna stretch it a bit and see how that plays out. So now let's put it out and see what the market can do. Did it open my trade? Looks like it opened my trade. It took me out once again. Bad trade. Not a good day. Not a good week. Not a good week, guys. But do we lose hope? We don't. We don't lose hope. We continue. This is a nice possible trend that we can see here. The market is just respecting that trend, guys. And my stop was open quick, so I'm now in losses because my losses are becoming bigger. Let me just adjust this. Let me unlock and see if the rate can be equal. Yes, because we want to be as fair as we possibly can be. Right, this is loss, 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 win-win. Right, so for me, in order for me to take a sell trade from this trend, I'm gonna place another sell stop below here, and my stop loss will be inside this level. Right, so now let's see how the market continues from here. You can see that the market is pushing above. Sort of a buy trend. Let's see. Okay, my trade is not open. Okay, my trade is open, guys. My trade is open. The market was struggling to cross below this level, was struggling to push above this structure. The reason we've seen this lot of stop loss hits is because the market was seeing that we could have caught this trade. Whenever the market might swing towards the downside, it needs to take people out. As you can see, 1, 2 trades are out. However, we are seeing sells. We are seeing sells. Whatever, it won't give us that sell easily because the win might be bigger, right? The win might be bigger. So I'm just going to adjust this to where the market actually opened. If you look here closely, the market is consolidating. It's not pushing up or down. It's more of a consolidation. It's a rectangle shape that we spoke about. It's more of a consolidation. When we see consolidation, the market might be taking out traders before pushing below. You can see here, the market was just pushing and taking out traders. So let's see if our trade will end up with a profit or a loss. Because if we profit here, we would have made up for these 3 losses. Looks like we actually profited from this trade, guys, and we came out victorious. As you guys can see, we are taking trades and we are coming out victorious. We are now in profit. 1, 2, 3 in profit. Only small losses. Our wins are more than our losses. We are back in track. We are back in profit. As you guys can see, manipulations are playing a role. We can see here this rectangle place was playing more of a consolidation. The market knew that we are trying to sell because of this strong sell trend, and we had 2 stop loss hands. 1, 2, 3 stop loss hands, guys. So these stop loss hands are of course a form of manipulations that happen in the market. Let's see if I go to one now, you can see them properly. Hope you guys can see how this market is operating and so on and so forth. So far at this moment, Let's see if the market can respect this level here that we have before we can continue with our possible trade. So I'm going to adjust this to the left so that we can have clearer charts, right? Star movement, guys, we are doing great. We are in profits. Let's see what the market can give us before we can continue from here. You can see that the market is failing at this level. Possible double bottom. Possible double bottom here, guys. I'm seeing possible double bottom here. Possibility there is 1, 2 possible double bottom, guys. A break above for me will indicate a buy. A break below will indicate a sell. A break below might indicate a sell. A break above might indicate a buy. Let's see how the market plays out. As you guys can see, guys, the market is trying to break above here. So I'm just gonna put it like this. Seeing this is a very weird setup. Let me just try to push this here and try to match the bottom with the top. As you can see, the market broke above, guys. This is a nice entry for a buy. So at this time moment, guys, I think I would go for a buy here. You can see we are seeing sort of a double bottom. See, possibilities are the market can push above. So my take profit will be a bit higher. And we're gonna see how that plays out. We are in profits, but the market is pushing below. Okay, this trade looks promising. Can I pull it to the side and see how long it will play out so we can get a more clearer view? So what I can do here, I'm seeing that the market is pushing above. I'm seeing this as a touch, so I'm seeing this as a possibility of a trend forming, right? Possibilities are there, and if I see another trade, I might as well take it. If I see another trade, I might take that trade. Possible buys. Let's see. The market is expecting our trend, and at this time moment we have created a sort of a ceiling that we crossed above. So if possible, we might go for another buy. If possible, another buy from here. Across below into this region will indicate a drop for me. So let me just lock this one and try to also push this above so that it hits this level here and we are out of the trade, right? Out of the trade if it hits that level. So I'm going to lock this one too. We have 2 trades. We are scaling in. Let's see. The market played in losses. As you guys can see, we almost thought it's going down. As you can see, guys, that's how the markets operate. So I'm gonna just come here and see if we can adjust. I can adjust my trend now to actually cater for what the market can do from this point forward. You need to know that, guys, for a new week you're gonna need to start your analysis. So it's basically like a new week for me. So I'm gonna start my analysis. Possibility of the market breaking below is there, but we are still confident in a trade. The first trade is in profit, the second trade is open and it's in losses. Let's see how it continues. You can see here the market almost scared us to push below. This is just more of a stop loss hunt. If I was in this trade alone, the biggest drawdown is actually to be a possibility of a big win. You can see this is a drawdown. This first trade is in profit, the second trade was in losses, and now we are both in profits. Let's see how the market continues from here. The market is approaching my stop, guys. I am worried. The second trade might have been a bad idea. might have been a bad idea. Let's see. The second trade hit my stop loss, guys. The second trade was a bad idea. It took me out. The second trade took me out with a loss. Let me unlock it. It took me out with a loss. And it might continue taking me out with the next trade as well. But we are still confident with the first trade. We'll let it continue to see how the market plays out. The market is failing to push below. So it's forming a new trend, guys. Guess our trend was sort of incorrect. It wasn't incorrect per se. I would say it's more of two trends, guys. I'm seeing two trends here. This is also market tricks. I'm seeing this as two trends, guys. That trend was valid, but the market, due to consolidation, when the market consolidates a lot, it changes direction. You can see here we have a very weird setup. I don't know if you guys know the setup, but it's a very weird setup, right? Comes with experience, guys. But this for me was a trend that is inside this trend, as you guys can see. So for this one, we took a loss. It's okay. Let me just adjust it to here so that it can be small. It's a loss here, you can see, but the first trade is in profit. So if we win big, because it's here. You see, we win big. But now I'm going to take another trade from here, because I'm seeing that the market came and played inside the trend and went below as a stop loss hunt, but now it's coming back. It's forming us this main trend. So I'm going to turn this into different color, guys, so that I don't confuse you, and maybe I can explain what I'm saying. This is a market trick, guys. It's a market trick. I hope you guys understand this trick and you've learned something from this trading session. You can see that the market would have pushed up, however it formed a trend in trend. You see, we can have a trend here and we have another trend below. So at this point here, I'm seeing a possible buy. Let's see how the market continues from this point on forth. Take profit hit, guys. Take profit hit. So the take profit from this one hit, the take profit from this one hit. So overall, we won 1, 2, 3, 4, 5 trades. We lost 1, 2, 3, and 4. However, our wins are more than our losses. You can see this is a big win. There's also a big win. This is a huge win. And this is a big win too. And yeah, this was a stop loss hunt with futures a loss, and this is a win too. So overall, guys, it was a nice trading session. Hope you guys learned a thing or two in terms of trades. This was more of focusing a lot on entries than analysis, because I just showing you guys, even though you can analyze, you have to understand how the market operates. There's a lot of things that come into play when you enter trades. There's a lot of tricks that the market does. You can see we came from here, a lot of trades, a lot of experiences. These things are possible. When you see such, you can have a buy stop and continue with the trade. However, when you get to continue trading, you're gonna see and get to learn a lot about this trick, guys. That you're gonna get to see that when you actually have a real trading experience, you're gonna have losses and wins. However, overall you profit as you have the edge of what the market is actually doing. When you're losing, the market can be taking out traders, or you could be wrong. However, as long as you have an edge, you're gonna come out victorious. This is your mentor, FS Gold, signing out. Hi there, everyone. This is FS Gold, your mentors, and in this lesson, we're going to be covering FX Gold Mastery of Entries Part 2. Yes, we are going to be looking at pure price action. So, in this lesson, guys, make sure that you actually take out your pen and paper and make sure that you take careful notes as we're about to break down how the markets actually operate. Do understand that this is the most and last important chapter that you need in order to help you find good entry points. We believe that once you get to understand how the market operates, it will help you a lot and go a long way in helping you spot good entries. So let's continue with the video. How to use price action, the FX Gold approach. These are the key points that are going to be covered in this lesson. Which time frame to use support and resistance trend lines, difference between key chart levels and support and resistance, how different time frame price action correlates, entries below 1 hour time frame, entries above 1 hour time frame, and FS code patterns explained in detail. Now the breakdown of the lesson has already been completed. Let's continue to achieve all these objectives. Which time frame to use support and resistance trend lines? You're gonna use your support and resistance trend lines on any time frame, meaning that it doesn't restrict you to any time frame. Point number 2, higher time frames shows long-term support and resistance. Smaller time frames show immediate support and resistance. Now, lastly, to properly identify support and resistance, find areas where the market usually changes direction, as that's where the market is most likely to change direction again. Now, let me illustrate what I mean by that. Let's say at this time and moment, guys, we are basically looking at how the market is operating. The market might begin by giving us a push towards the downside. We can see this by such moves, and the market is now moving and ranging like so. So what I'm about to give you guys is a clear overview of how to spot the difference between the two, and giving you an overview also on how the market might act and operate, right? So the market is now moving like so. As you can see, we're seeing a push towards the upside. We're seeing more of a double top there, and the market is coming back and ranging towards the downside. Now, for you to understand different time frames and how to apply support and resistance lines is to know how you're gonna apply them. So let's say now, at this time moment here, we do have a very strong support zone here. The market is, of course, failing to push below the structure. So we know that it's a very strong support zone. However, it's a big area, meaning that this is going to be a support from a higher time frame. Secondly, guys, if you come here, you can see that we do have some support and resistance line here, but they're in a smaller time frame, and they can even go to as little as spotting them at this point here. So knowing how to effectively apply this can help you spot entries. As long as you can see the market coming back to retest your support, that can also trigger you to knowing that the market might give you some reversals. As you can see, this was the first touch, second touch, indicating that reversal. We can see the market has been reversing at this point here, which can help us and go a long way in spotting where to enter and exit. Now let's continue with the lesson. Difference between key chart levels and support and resistance. You have to know that, guys, key chart levels are important technical levels that create possible reversals. Traders look out for key chart levels to place their buy and sell orders around those lines. Either market execution, stop orders, or setting limits. Those are the 3 types of entries you can make when you trade the Forex market. Now, key chart levels can be used even during choppy weeks as the market ranges only. As a scalper, you might stand a chance when you use key chart levels, because you're going to be able to identify those levels where the market is going to be reversing even in smaller time frames. Now, as we've taught you, the market is not always trending. In fact, it's often said that the market spends more time consolidating and moving sideways than they do in trending conditions. What that means is that the market spends more time consolidating than it does trending. Luckily, with the knowledge of how to trade simple price action setups from key levels, we can try to also effectively trade choppy markets as well. You have to know that, guys, if you're going to take any trade during choppy markets, you have to apply high proper risk management, meaning that you have to use small lot size and make sure you minimize risk as much as possible. You can trade swing levels. A swing point does not need to be confirmed by multiple rejections of price in order to be considered a valid support or resistance levels. So now I'm going to illustrate what I meant by key chart levels. So let's say that the market is starting with a very strong bearish momentum. You can see that the market is now at a very strong bearish momentum. It's giving us those push towards the downside, and before it reverses, we can see some part of a double bottom and a push towards the upside and a retest, and the market starts to range like so. So what we can see here, guys, is a few chart levels. You're going to see the difference between key chart levels and support and resistance. So if I come here, I can see that the market has a very strong key chart level here. You can see that we can see it by a swing point. You can see this another key chart level here, and you can see this is yet another key chart level. You can see the key chart level with these two touches here, right? You can see another key chart level here. You can see another key chart level here, right? Just try to spot those key chart levels, guys. It's more of applying the FS code high and low strategy. What you need to do, you need to spot the key chart levels, those levels where the market reverses, right? Because once you get to a point where you actually can execute the key chart levels, it means that you can execute good trades. So what we use these key chart levels for is to identify those strong market moves. You can see the market came and tested this level, making it more of a swing low for this time and moment, and it came back, crossed below, creating a small low, coming back and touching that line, knowing that now it was acting as a support. It came back and acted as a resistance. The market further continues, breaks below the previous support, comes back, pushes back up, and retests it as a resistance. So you can see those key chart levels here would have given us two good entries. You can see those chart levels, guys, is more of a level that's respected in the market. It's not more of a zone, but levels that the market rejected price upon. You can see at this price the market is rejecting. So you can see the key chart levels also goes hand in hand is understanding those key levels, those price areas where the market is rejecting. And the thing about understanding how this operates is that key chart levels can also just be created by a simple line. A market can hit a high, creating a swing high. So from there, we know that we're going to sell for the longest time, and the market has created a high for us, meaning that the possibilities are it can continue trading and come back in the future. But we know at this level, the market usually reverses. We have a key chart level at that point. So we know should the market continue that level, we're going to look for possible reversals towards the downside. I hope you understand how to effectively apply this. Now let's continue with the video. Difference between key chart levels and support and resistance. So how to do that? You should think of support and resistance more of zones rather than concrete numbers or lines. Support and resistance consist of key chart levels. However, they also cater for supply and demand, meaning that when you use support and resistance lines, guys, you have to cover more of a zone than a straight line. Support and resistances actually help us a lot to know where the market will reverse, and can also be used by supply and demand, meaning that you can use it to see when the market is overbought and when the market is oversold. Support and resistance areas can help us know how far the market is retesting, e.g. surplus of buyers can make a fake out, but you can really cater for it with a resistance zone. I'm going to effectively show you this as well in an illustration. So support and resistance zones are usually presented by the candlestick shadows. You're going to see that once we know how to effectively apply the zones, they're going to be shown most of the time by candlestick shadows, by spikes towards the downside. So try to also use line charts when analyzing to properly identify the market moves. You're going to see that sometimes when you use line charts, you're going to remove most of the noise from the market. As we've seen with the previous lessons, we also try to advise you to also switch to line charts and come back to candlesticks, as you also need to see how the market is operating. Now, these highs and lows can be misleading because oftentimes they are just spikes from market reactions. As I've said, guys, some of these market moves, you're going to be seeing them on your analysis, but at the end of the day, they can be just simple market reactions that amount to no further information. Now, let me show you what I mean by that in an illustration. Let's say, for example, the market is ranging like so. How a support and resistance works is more of a zone. we can see here, guys, that the market is in a zone. We can see the market is not hitting the same price. See at this point here, guys, the market is not hitting at the same price. However, we're gonna put it in a zone instead. So the difference between a key chart level and a zone, the market is at sort of different lines. You can see the line here and here and here. All of them are in a support, right? So in this area, we can say that the market is oversold. When the market comes in this area, it is oversold, and you can see the push towards the upside. You can see it's not an actual straight line. The lines are on different levels. However, in this zone, we know that the market has oversold, and we expect the push towards the upside. So the difference between chart levels and support and resistance zones is to know that where the market is overbought and oversold, the areas we're expecting market reversals are going to be more than just a line, but an area instead. Lastly, I want to show you how we can effectively spot this one. So what I want to show you here is that this is also a zone, guys. This is also a zone. Even though the market is spiking, it's creating some spikes or shadows. Don't let them mislead you. This is still a sell, right? This here is still a buy. So what do we mean by that, guys, is don't let the market shadows to fool you. We are calling this a zone as well. This is a very strong buy zone. We can have normal spikes that the market might be rejecting before giving us the overall direction. As you can see as well here, we do have those young shadows the market might be rejecting, especially on high time frames as well, where the market is giving us the overall change of direction. You can see those overall change of direction came with market spikes, and some even spiked outside our zones. However, we know at the zone the market reverses, so we use these zones to indicate market reversals. So without any further waste of time, let's continue with the lesson. Entries below 1 hour time frame. Now, looking for entries, you must enter upon a break of a trend, a continuation of a trend. It can be a smaller time frame or a bigger time frame, or when you spot market weaknesses. You're gonna see that basically having such rules for your entries is making sure that you only enter after confirmation. The reason we're having these 3 rules is because we think you guys to learn that when you take a trade is when you're seeing a confirmation of an entry. When you're seeing a confirmation of an entry, you take that trade. You're gonna see also when we cover the practical side on how the market actually moves, you're gonna see a lot of market weaknesses, as some of them they can present to you entry confirmations. When the market shows signs of weakness, we can see it as an entry confirmation and enter upon those market reactions. Now, when you can find any entries, you can go as far as 1 minute or 15 minutes charts. That's when you are trading below 1 hour time frame. Smaller time frames are often used for entries. If you can see anything and then you're looking for an entry point, you can go to a smaller time frame and see what the market is showing at its earliest forms. When you can find any entries, make sure that you try to analyze and use pending orders to wait for the market to give you more direction or market movement. The reason sometimes you have to wait, the market won't give you entries all the time. The market might give you good market moves, but it doesn't mean that you have an entry point. You have to understand the difference, guys. There's finding good entries. You need to focus on finding good entries. Your ability to spot them will improve. You're going to see on how we identify all these entry points on the next video, which is going to be the practical side of entries. Number 2, entries above 1 hour time frame. Looking for entries, you must enter upon a break of a trend, a continuation of a trend. It can be a smaller time frame and a big time frame, or when you spot market weaknesses. This is also above 1 hour time frame, guys. We can also continue with the continuation of a trend. You can also enter upon a break of a trend line, and when we spot market weaknesses. Market weaknesses is just as explained previously. Now, when you can find any entries on bigger time frames, you can go as far as 15 minutes or 30 minutes charts. Small time frames are often used for entries. So when you can find any entries above 1 hour time frame, you can also go to smaller time frames, basically less 15 minutes or 30 minutes charts. When you can find the entries, like we've said before, try to analyze and use pending orders to wait for the market to give you more direction or market. The reason is when you wait for the market to give you more direction and you have your pending orders and the market comes and opens your order, it's most likely that the market is respecting your setup. So you need to make sure you actually invest more in such trades. Now, should you analyze and set pending orders later when you come back to your charts and you find that the market played out as you predicted? This means that that particular trading pair or instrument respects your setup. Let me quickly illustrate what I mean by what I said. I'm not going to cover a lot here. I'm just going to cover things I want to touch on quickly, as most of them are going to be covered as well on the practical side of the market analysis. So what I want to show you here, guys, is those young small tricks. So what I'm starting is here, it's a break of a trend. As I show you guys, what you need is an NT confirmation. At this point, the market is still in a bearish momentum. Once we break above, we can see this as a confirmation of going for a buy. We can enter upon a break of a trend. After a retest, we can go for a buy. Also, when the market comes here, it starts playing inside this trend, and we are at this moment, we are looking for buying opportunities. We can enter a buy opportunity as we are still in a continuation of a trend. Once the market breaks to each side, we can continue with where the market is going. Also as well, this can be done in bigger time frames as well. It can be bigger time frames. We know when the market comes at this point, we are looking for reversals. The market might come, give us some spikes first, give us some retest, and continue with the push towards the upside before actually giving us that push towards the downside once again, giving us that entry and continuing on a bigger time frame. Lastly, upon market weaknesses, you're going to see some of the tricks I would like to use is when we understand how the market operates by giving us that break outside. Once we break outside our bullish move, we can expect the market to shoot down and reverse from here. This is a trick that you're going to be able to see. We like to use it to actually spot reversals, as it doesn't always work all the time, but it works more times than it doesn't. So you're going to see this also signs of weakness. When we see the market continue from here, we can also enter upon this level and continue and close and continue with the reversal as well. This is just a weakness that the market likes to show most often. Without any further waste of time, let's continue with the lesson. FS good patterns explained in detail. Being capable of identifying trends is one of the most core skills a forex trader should possess, as it can prove to be highly useful in making forex market predictions. You're gonna see that, guys, trends play a huge role in the market. The trend is the general direction of a market. Whether you apply trends or not, they are there, and they are the most highly effective tools ever used to analyze the market. You're gonna see when we analyze, guys, how effective trends are. Now, trends may vary in length from short to medium or to long term. Being able to identify a trend can prove to be highly profitable, and the reason is that you'll be able to trade with the trend. Also note that only in rare occasions the market will form trends that goes through the market, and these trends carry high probability trades. I'll show you what I mean by this in an illustration. In a context of any strategy, it is best to trade with trends. Like I've been saying, guys, you have to understand FX good patterns. All our strategies, at the end of the day, they come from mastering trends. The only last thing you need to know is be able to understand sessions, when the market closes, when the market opens. But as long as you have trends, any instruments that can be added on top of that will help you better time your entries. Now, let me show you what I mean by some illustrations. So basically, what we mean by what we've been saying, we're gonna start with trends that go through the market. Let me show you what I mean by that. Let's say this time moment, we have a trend here and we have another trend here. We have a trend line and we have another trend line below. You can see that the market is in a trending format. It's now going for a bullish momentum. The market then breaks below, comes back and shoots back up, hits this bottom, shoots back up, and you can see that there's something happening here. As you guys can see, or we can see here, you can see that we have another trend as well. You guys can see this trend is going through the market. I don't usually like to trade like this. However, don't misuse this. This only happens in rare occasions. This is more of a confirmation of an entry for us. When you see the market forming this kind of action, you can expect the market to know that we're in this trend. It came back, it played another trend. This side is more of a stop loss hunt. We call it a more of a stop loss hunt as you understand how the market moves. The market is moving in this region, comes back to this region to get the momentum to actually finish the top. It hit the top of a trend, it will come to retest the bottom, and will come back to hit the top. So at this point here, we can even go with an increased lot size. You're gonna see that there's different types of trades. There's low probability, there's medium probability, and there's high probability. At this point, we call it high probability as you been in the market to actually shoot and complete this in the fastest form. This is a high probability for us. We take this trade with an increased lot size. It can be from 0.10 to 0.15. We increase the lot size just a little bit as it's more of a high probability to us. The other remaining ones are going to be shown on the practical side of the market. I just wanted to show you what we mean by these rare occasions. Why should we keep an eye on volatility? Market volatility can be described as an actively moving market. During this period, earning potential for traders can be huge when anticipating market volatility. As you guys have seen, we're also going to cover sessions later in the future as they can also help us understand how effective volatility is. We can make more money when the market is more volatile as we're seeing more moves from the market. Market volatility is the frequency and the severity of the price movement of any trading instrument. Volatility happens in the market when there's an imbalance of traders going in one direction, e.g., 95% of traders going long with just 5% of traders going short. Or remember, that is when there's less people selling, when there's more people buying, the market shoots more in the direction of a bullish momentum, as that creates a lot of volatility. The main cause of volatility is market sentiment. If traders can see a buy or a sell trend begin, more traders will follow, and it's creating a snowball effect. When we have more traders following that direction, we can have more of a market volatility, and the market will then give us a bigger push towards that direction, right? Due to market volatility, we have a bull and a bear volatile market. This will be explained further in this video. So what we mean by what we've been discussing, guys, is understanding volatility. As you guys have been seeing that as you can see, guys, the market here spent more time consolidating than it does when it's volatile. Those volatile moves is where we earn most of our money than when it's consolidating. Here, the market is moving slow. It's just choppy a bit, normal market moves. But once we are out of those normal market moves, you can see some bull volatile. When you see the market is pushing up like this, we call it a bull volatile. And when it's pushing down in the fastest, we call it a bear volatile. You can see where you can also identify when this is happening. You can make most of your money because you're going to make the biggest moves in the shortest period. So the market spends more time consolidating and making slow moves than it does giving us those volatile moves. But with those volatile moves, it's when we earn most than when the market is not volatile. Now let's continue with the video. As we've been saying, guys, bear and bull volatile markets often happens after manipulations. As you guys can see, I said that they happen after consolidation. They often indicate an end of market consolidation or choppy markets. A strong bullish market after a long consolidating bearish market. I'm going to show you as well in illustration. In a bull volatile market, look for a pullback, a reversal, and then find a logical profit objective on the long side. You're going to see what I mean by that. You want to consider dropping to a lower time frame to improve risk or ratio reward upon your entry. For you to have an entry on a bear or bull volatile market, you need to go to smaller time frame to make sure you're entering after some retests, not when the market might reverse with you. Now, a bear volatile market is the opposite of a bull volatile market. It's when the market is shooting down rather than when it's shooting up. You can trade the bear and bull volatile market by execution or sending pending orders. You have to patiently wait for the market. However, volatile markets are also risky. Trade them with caution. As you guys seen, the market moves fast. The market can also move fast towards the downside and then reverse quickly as well towards the upside and start pushing in that direction. You have to know that bear and bull volatile markets are also risky as the market moves very fast, as you can be too slow to actually comprehend the speed the market moves in. Now, this is because the market won't allow you to win every time. Those volatile movement may come in spikes, may come in rejection on both areas. You can push towards the upside, come back and push towards the downside quickly in 4-3 times just to confuse you. They happen when there's news around, they happen when there's a lot of volatility, or when there's a lot of traders going in one direction. So the market can also make sure that you lose. You can catch all these trades, however, when you do, you're going to profit a lot. View losses as cost of running business. On the topic of losses, why do all traders go through losses will be covered in the next slide. But before we do that, let me show what I mean by bear volatile markets often happen after manipulations. We can see that the market has been ranging like so. The market has been ranging for the longest time, right? The market might be ranging like this and start shooting towards the downside. The market might be indicating to us that the break towards the upside might be coming. You can see this by some few moves. The market is creating a new trend here, started from this trend. The market has been consolidating. Here's a point of area of confusion. The market can back up, push down. This is just creating some moves until the market shoots up quickly, comes back, make 2 small moves, consolidates a bit, comes back, retests, creates a key chart level area, comes back and kisses one more time and starts shooting down, coming back down, shoots back, rejects, sharp. You guys can see these are market moves. The market can do that as well. The market can consolidate. Let's say, for example, here, when we analyze from a higher time frame, we're looking for a buy. The market did not buy immediately. It started showing us like it's going down. It started to fool us, but we saw that the market is rejecting. The market is failing to push below. Once it stops failing, it starts coming with so much power, so much strength towards the upside. You can set a buy stop. It opens your buy stop. You're in profits. You're quick. You have to know where you're going to get out. You can get out when you're here. After the market comes back, reverses, creates for us a very strong key level area there, comes back and rejects, and you can see a very strong resistance area at that point. It comes back, retests below it, comes back, comes to kiss that last time, our key chart level area. We can see the key chart level area also helps to see a continuation of a bear volatile market, giving us a last confirmation towards the downside. The market is shooting once again, and we can see the push towards the downside. You can see this can be a choppy week. You can identify this as a choppy week, and we can define this as a trendy week as well. You can see most of the time when we're out of manipulations, we're going to see a lot of volatile market movements. As long as you understand how the market operates, guys, you're going to be able to know on how to react when such things happen. Now we are covering the most and last important slide of this entire lesson. Why do all traders go through losses? I hear people saying that when they trade, they don't want to go through losses. Well, I hate to break it to you, but losses are important. Losses are part of the journey. Losses are part of the process. When it comes to losses, no matter how big or small, losses remind us to never stop learning. Yes, you must respect the market, but don't fear the market. As you're going to see, guys, when we actually take the practical approach, when we trade, we should respect the market, but we should not fear the market. The market can come to you and give you a buy setup, right? Let me just go to some illustrations. Let me show what I mean by that. The market can come to you. The market can be on a bearish momentum and then break our trend and give you a nice buy. You can see this is a nice buy confirmation. You're in a buy trend. You want to go for a bullish momentum. Continues. However, we are failing to push. It comes back. We are failing to push. We are failing to push. The market is now telling you that there's a very strong resistance here. Don't fight the market. The market gave you a buy. That is true. The market came and gave you a buy. You wanted the buy to complete that reversal triangle strategy of ours towards the upside before looking for a push towards the downside. You wanted to see that push. However, the market is rejecting here. Don't force. It means that it's been consolidating for the longest. We are now expecting a push towards the downside. The market is rejecting, guys. Even though we want the market to push up, it doesn't mean that we shouldn't take what the market is giving us. We can see the market is giving you an entry. Even though we want this to happen, don't fight the market. Respect the market, right? Let it push up. Even though you're going to lose this trade, doesn't mean you should fear the market. Take what the market gives you. Let the market lead you. Even though we saw that entry of a buy there, the market came back and gave us another entry of a sell. Don't force direction. Even if it can give you a buy and later comes and give you a sell, take the sell. But wait to see the confirmation. It gave us a lot of touches to see. Now, the market is going for a sell. Our first analysis has been invalidated by this structure here. we're going to go for a sell and push towards the downside. I hope you guys can understand on how we can also transact from having one trade, having some consolidation that might giving us more time, market failing to push above and changing the setup due to consolidation. You can see the setup is now different. It's no longer the same. The setup is now a sell setup. So we're going for a sell. So when you reach our professional level of trading, you'll get to understand why we work very hard to always sharpen our skills by regularly trading the Forex market. As a trader, you need to trade more often. As you know, guys, football players, they always practice. Those people who are playing rugby, they always practice. People who are playing football, they always practice. People who are playing tennis, they always practice. Singers are always singing. Dancers are always dancing because they want to improve their skills. If you want to improve your skills, then work on your skills. Work on perfecting your craft. If you love your craft, keep on sharpening it. Your blade will not be strong if you don't continue sharpening it. Continue sharpening it, it's going to be at the most highest performance of its peak. So, even when you reach a consistently profitable level, you will still go through losses. Yes, overall, we win. However, the first thing to get right is the mindset. No one has a 100% win rate. Trading is not about hitting take profits only, but it's also about hitting stop losses. Stop losses are lessons. They are reminders that you are not the king. Know that when you win, let's say you have a very great week, you hit 100% hit rate. Those wins, they can go through your head. Those wins can make you feel like you're a god. Don't let them do that to you, because now you are failing. You are failing to let the market lead you because you are a god. You think you lead the market. The mindset is wrong. You are not the god. You only follow what the market gives you, because once you feel like you're a god, you're going to lose a lot. You're going to force direction upon the market. You're going to want the market to do what you want it to do and not what it's presenting to you. Only take what the market presents, not what you want, because you're going to see when you win, your wins are going to go through your head. However, when you lose, those losses will go straight to your heart. You see, so don't let the losses also take you over as much as don't let those wins also take you over. Always stay neutral. Don't be too hard on yourself when you take a loss. It's part of the process. As you say, guys, a loss goes straight to the heart. Don't take it too personal. It's the market. The market moves as it should. The market can try to disrespect all kind of setups. That is known as a choppy week. When you experience a choppy week, just step aside, go to a demo if you may, or take some space from trading and get to a point where you're getting better yourself. When you go back to the market, you come as a refreshed person and you check if the market is out of some consolidations and you can continue with the normal movements. When the market is making sure that you lose a lot, take a break. Don't let it consume you. So the last line, don't ever give up. Only you have the power. Get up and go get it. You guys are part of the winning team. Make sure you actually practice what we teach you. Right now, we're about to cover the practical side of Master of Entries Part 2. Stay tuned. See you on the next video.
Welcome, guys and girls. Now we're going to be looking at the market patterns that we actually look at when you look at the markets. So one thing I want you guys to realize is you need to take clear notes and actually note down every word I'm going to say, because this is clear demonstration of how the patterns look like and how the patterns we actually apply them, so that you can be able to see and spot these different things and different time frames and different patterns to say. So without any further waste of time, let's jump to it. So pattern number 1, a consolidation channel. So a consolidation channel, it looks in this nature. As we have taught you guys that there's an impulse move and a correction. We know there's an impulse move, a correction, impulse, correction, impulse, right? But however, a consolidation channel is in this sense. It's a ranging market that is going on the right hand side, sideways, right? So this is a manner of, it's creating a high buy opportunity or high sell opportunity. This means that this is when the market is breathing. This is when the market is taking a break from impulses. So in this sense, guys, a consolidation channel looks something in this nature. So we would have a push to the upside and then consolidate sideways, creating a structure in a sense of a rectangle shape. As you can see, in a sense of a rectangle shape, it will look something like this, because the market is ranging only in between this rectangle phase. We know that we support low and we resist high. So it will just play around this rectangle, forming a continuation pattern. Just remember, guys, a consolidation channel that occurs after an impulse move and it's in a format of a rectangle shape, just understand you're gonna be looking for continuations to the upside or the lower side, right? So in that bearish market, we look something in this nature. We would have a push to the downside and then consolidation sideways, creating the nature of a rectangle shape right there. And then we know that we're going to be impulsing again with a breakout to the structure to the downside. As we know that the market nature, it's a push to the downside, correction, and then push again. So that's the nature of a rectangle, or to say a consolidation channel. So in the bullish market, it will look something of this nature, push to the upside, correct sideways, creating something in nature of a rectangle shape. We know that we support low and we resist high before we actually get confirmations to push to the upside. So that is what you need to look for, guys. But however, remember something, it's not always a perfect picture that you will always have with regarding the markets. You always need to read in between the lines of how is it presented. Is it presented in a shape that we're looking for continuations, or is it represented in a shape that we're looking for reversals? Sometimes the consolidation channel might be in this sense. You know, we're correcting sideways, but sometimes it might push up, push down, go back in the same way. So you gotta look, guys, this might be acting as a head and shoulders. So be actually sure that you check on these things and delve deeper into what's presented by the charts. So all right, guys and girls, we're going to be looking at Euro USD. So as we said, we're looking for what? A continuation pattern, which is a consolidation channel. So without any further waste of time, let me just copy this bit of price right here. Just copy it from this sense and then put it right there. And then as we copy it aside, you're going to be able to read in between the lines. As you can see, this was an impulse move. This was a correction, as you can see. Then impulse again. Now we're having a correction. As you can see, it's pretty clear to understand these things. So now we're gonna spot our rectangle shape. What do? We don't see any in between these lines, but however, I'm seeing some bit of price right here. Let's just go to a 4-hour time frame. As we drop it to a bit lower time frame, I want you guys to see something or spot something. So we actually having a bit of price right here, right? As we're having a bit of price right here. Remember I said you gotta be able to read in between the lines of what's presented by the charts. As we can look closely here, this is a correction in a phase of a rectangle shape. But however, look at what's happening. It didn't continue to the downside, but however, it reversed to the upside. Look what happened. If we look closer to the market, we had something in nature of a head and shoulders. But however, it's not quite presentable. That is why we say it's important for you to read in between the lines, right? So you can see that it pushed up. But imagine if we had a high push to the downside and then we corrected to the lower side. It was going to be actually a nice way to actually say this is an opportunity for us to look for continuations. But however, let's look at the bidder price. So as you look at the bidder price, guys, you're going to see that this is in nature of a rectangle shape, right? And in nature of a rectangle shape, inside we're also experiencing some patterns within. As you can see, we're experiencing some patterns within. And also here we're experiencing some patterns within. We're going to learn about these patterns, guys, as we delve deeper into the pattern side. As you can see, so the real nature says we have a push to the downside, correct sideways to get those confirmations before pushing to the downside. Now, this was the one where I was explaining that sometimes, guys, doesn't open up, or it doesn't look at the bigger picture, or it's not presentable in a perfect picture that we gonna be looking for continuation. But however, you just gotta be able to read in between the lines. As you can see, push, exhaustion, and then we had another push, guys. It corrected again. So this is telling you guys that it's failing to break below to retest and give us continuations. But however, it's ranging in between this rectangle shape, right? So that's the failure of the consolidation channel, but not a sense of failure, but it's a possibility that you always gotta look for. However, a consolidation channel occurring in a rectangle shape, it needs to be the one that you look for continuation patterns. But however, it's not going to be always in a clear picture. You just got to be able to read in between the lines. So now let's focus on some bidder price right here. As you can see, we're having that bidder price saying a correction that occurs in a rectangle shape. Let's copy it and put it aside. As you can see right here, we're ranging in a rectangle format. As you can see, if I copy this price right here and then just demonstrate it right here, you're gonna see, guys, this is clear, beautiful. That is why the mid time it broke to the upside, we literally continued to the upside. As you can see, this was a push to the upside, and then this was a correction, and then push to the upside. This is a correction, right? So these things, guys, are pretty clear to look for continuations. But let's look at it in the real market. So as we put it right here, guys, you're gonna see that this was a correction format. As you can see right there, This was literally a rectangle shape because we know we resisted high and supported low, resisted high, supported low. So it failed. That the meantime it broke out of the structure. Look what happened. It literally broke out, retested, and continued to the upside. Now it's creating another format of a rectangle shape, which is a consolidation channel that is ranging in between, guys. As you can see, if you look closely inside here, we're still having those pushes to the upside, corrections, and then as you can see, push, correction. But however, we're in a consolidation channel here, of which we're looking for something in this nature. If the market pushes up, it needs to consolidate or maybe give us a correction to retest the level of support and then continue to the upside. But however, I'm definitely sure now this makes sense. A consolidation channel is something in nature of this. It creates a rectangle shape and then supports low. They're equivalent, as you know, guys. Support low and resist high before looking for continuations. So guys, that is it for the consolidation channel. Let's get deeper to the next pattern. Pattern number 2, falling wedge or a rising wedge. So guys, these are the most sensitive patterns to trade because they literally sometimes they're medium probable patterns. Sometimes they occur to make you profit from the market, but sometimes they occur to trap you inside the markets. But the nature of them, they would look like this. So if on a bullish market, we would look at something like a push to the upside, correction to the lower side, forming a channel that is actually going to the lower side or on the downside before actually continuing. But however, the nature of them, guys, doesn't always occur in this nature. Or maybe on the bearish market, they would look in the sense, push to the upside, create a rising wedge to going to the upside. It sometimes looks steepy, you know, like it looks steepy like a mountain, or neither, yeah, the same as a mountain. Then it will push to the downside. But however, looking closely to it, guys, they might be trapful because they act in this sense. So as I've said, guys, the reason why they are so trapful, it's because they normally do these things. So the market would be actually pushing to the upside and then correcting sideways, going on the lower side or neither going to the support. But then only to find out that this guys is acting as a trap. Sometimes the market prefers to do this. The market would push to the upside, corrects to the lower side, and then continue to drop. That's why we're saying these steepy ones are not the most high probable, but they are medium probable. It doesn't mean they don't work. So the only time they would work is if the market pushed to the downside, corrects to the upside, forming a rising wedge to retest something, maybe to retest a resistance or to retest support, right? That's how they become high probability. But normally the market would push to the upside, correct sideways, going to the lower side, forming a falling wedge for continuations to the upside, only to find out that it will break the structure that you have created. Break the structure that you have created. Let me just cater for it right now. Break the structure that you have created to actually continue, go low, retest right here and drop. So that's how, guys, they become so trapful. But however, we're looking for continuations when you look at this pattern, but don't just focus on what you know. Focus on reading in between price action. That's the most important thing. Or maybe in the bearish market, they would look at something in this push to the downside, correcting, forming a rising wedge, right, guys, before actually continuing. So this strategy, the best thing about it, guys, it makes you wait for the markets. Imagine if you say you sell at the current price right there, and then the market decides to go down, respect this level, and then continue up, break out the structure, and continue to the upside. What's going to happen? You actually set yourself an unnecessary losing trade. That's what I'm saying, guys. You gotta read in between the lines. It becomes more clearer if it has something to retest on. So for instance, on a bullish market, it would do this: push to the upside, forming a falling wedge, right? And then create a structure. As you can see, create a structure. Maybe if we have a support zone right here, it might most probably come back, retest and push, break out, retest on the structure that has been created above. After retesting, that's where we put in our buy stop. It triggers us, we are in profit. And then in the bearish market, it will look something in this nature: push to the downside, forming a rising wedge, and then creating that pattern we're looking for. Wait for a breakout and then retest. That's when we enter, and then we're gonna be in profits. We gotta say reading in between the lines, because reading in between the lines will help you to spot these breakouts and retests to spot continuations to the downside. But however, this is a continuation pattern, guys, and don't make it your main priority, because it normally doesn't work. It works most probably 60% of the time, but it's a pattern that we needed to share. It doesn't mean it doesn't work, guys. It literally works, but it's just that medium probable pattern to trade, a rising wedge or a falling wedge. So let's look at the real markets to actually see and spot these things. All right, guys and girls, we're gonna be looking at GBP USD. So on GBP USD, we actually seeing something in nature of what we have already spoken about. Remember, guys, I said to you, a falling wedge comes from a bullish market, right? Look at here what happened here. We had a push to the upside, right? And then correction going on the lower side, forming that falling wedge, and then it continued to go up. Now, let's look at what happened after that, right? What happened after that? Look what happened. The market literally pushed to the upside and then created a bigger picture of a falling wedge, but it never went to the upside. That is what, guys, I said, be careful about. It sometimes catches you on the wrong side of the market. Look what happened. When the market literally created this structure, right here, as you can see, literally created this structure. Look what happened. It literally caught a lot of people on the wrong side of the market. But if you are able to read in between the lines, you're gonna be able to spot that this was a fake out to catch people on the wrong side of the market. But what do we do? Remember, guys, I taught you about evolving, emitting markets, right? Literally emitting trend line. So if you put it right there, you're gonna be able to spot this was actually a trapful pattern to say. Because what happened? A falling wedge occurs in a sense to respect or to say to confirm continuations to the upside, the same way as it did right here. As you can see, this was a falling wedge right here. Right here, it was a falling wedge. As you can see right there, guys, it was a falling wedge. It was going to the lower side, but look, it went on the lower side to respect the structure. Can you see that? This was a lower structure, guys. This was a resistance. It broke out, came retest to respect the support. And what I said is it only becomes high probable if it has something to retest. This had nothing to retest, right? As we can look close, if we drag it to the next side, it literally respected the previous support zone. As you can see, there's a support zone over here. It supported over here, but however, it also had something to respect at the top right there. As you can see, that is why it failed to literally break to the upside, but actually trap people on the wrong side of the market to tell them that we're looking for continuations. But however, it wasn't, guys, a continuation. That is what I'm saying. These patterns are literally one of the most sensitive, because you gotta be careful how you trade them. You're not just gonna trade them for the sake of having trades running. You gotta be careful because they are most trapful, guys, right? So we have looked at the falling wedge. Now we looked at the beautiful side of it, and then on the trapful side of it. This was a beautiful side of it. A push to the upside, correction, forming a falling wedge, and then it continued. Now this was the trapful one. Push to the upside, correction, trapping people on the wrong side of the market, and then it dropped. This, guys, was a drastic drop. If you can look closer, it was a drastic drop. So that's how we trap people on the wrong side of the markets. So let's look at another different pair. Okay, guys, now we're going to be focusing on USD CAD. So we have already explained how a falling wedge looks like. Now it's time to explain how the rising wedge looks like. So a rising wedge, guys, occurs in this sense. So we're just going to copy a bit of price right here. As you can see, I said a rising wedge occurs better if it has something to retest, right? So a rising wedge is in this sense. So as I see it, let's just copy a bit of price right here. Right, before, let's just copy this bit of price, put it right there, and then just make a sample about it. As you can look closely, I said the nature of a rising wedge, it will look in this nature. Push to the upside, correction towards the upside, and then looking for continuations to the lower side. However, it's not always picture perfect because these patterns sometimes can trap you. So as you can see, we had the first rising wedge over here, and then we had the second right here. We had the second right here, and then these were normal consolidation or rectangle patterns, as you can see. So we are not there. So these ones became the most high probable. Remember, I said when it comes to these patterns, you gotta be able to read in between the lines. It has to have something to retest. So as you can see, the reason why it turned right there, it had something to retest. We had a push to the upside, as you can see from here, push to the upside, correction, forming a double top formation, push to the downside, correction, forming a rising wedge to create a triple top right there, and then it pushed to the lower side, came back, had something to retest, push to the downside. So guys, this was the most beautiful one to spot. A rising wedge needs to have something to retest, push to the downside, correction upside, and then something to retest. Actually what? A resistance zone, as you can see, retest the resistance zone before actually pushing to the lower side. However, a rising wedge and a falling wedge, they are both for continuation patterns. On a bullish market, we're looking for a falling wedge. On a bearish market, we're looking for a rising wedge. So let's just look at the bidder price right here. That was most trapful. So guys, now we have found a bidder price, which you're gonna copy this one and right there, just put it lower side right here. So guys, let's look at this price to actually make sense. So the trapful side about a rising wedge, it occurs in this nature. Remember the nature of it, it looks like this: push to the downside, correction to the upper side to retest something before actually continuing. But however, in this strategy, we use stops, we don't use market execution. But sometimes we do use market execution, but not always though. But yeah, you're gonna learn about these on the entry lesson. So what happens when we're looking for this bidder price? So as you can see right here, guys, we had a rising wedge from the push to the upside, right? And then when you hit a rising wedge, we always have something to retest on. But however, this is where evolving comes in. Look what happened in the real markets. We had a push to the downside, obviously creating a rising wedge. Imagine if you were to sell right here. The market was going to be trickling. It kicks you out, then you're out of the trade. And then you start saying, the market doesn't respect my setups, the market doesn't favor me, and etc. But you just got to be able to read in between the lines. So the rising wedge, the trapful side about it, it occurs in this nature. So the market had a push to the downside, correction on the upper side, forming a rising wedge. But however, look what happened on that rising wedge. The market literally created a correction within a correction. So this was a correction, it also created another correction. And remember, the market, if it trickles a lot, it tells you that it's forming a different structure. That is why, guys, we needed to evolve. Look what happened. These could have trapped people in the wrong side of the market, but if you read in between the lines, you are going to be able to spot that now it's creating a falling wedge, which turns this rising wedge an impulse, and then this is a correction. So you're going to learn also about how the market price action tends to tweak or change. So if this was an impulse move and then this correction also corrects in a corrective format, forming another correction within the correction. This was a correction, but now we're actually forming another correction, which becomes more confusing to actually learn how to read in between the lines. But as I said, the only way you could do this is you being able to read in between the lines. So as we read in between the lines, we were going to be able to spot that, okay guys, so now our trend line to support our rising wedge failed, right? As it failed, we need to what? To evolve, right? Evolving or emitting structures. As you can see right there, this failed. This means now, guys, we needed to evolve to put our structure right here. Now it created what? We can see it created a bigger picture of a rising wedge. So this is a bigger picture of a rising wedge, push to the downside and correction to the sideways. Push to the downside, correction, it broke out, came back to retest and dropped. That is why, guys, I said to you, it's important to look at the breakout. For it to be high probable, the breakout needs to be impulsive to have a retest. But if ever it breaks out correctively, it's telling you that now the prices are literally changing. As you can see right here, guys, the push was on the downside, it corrected sideways, but however, in these correction, it literally broke out the structure correctively, telling us it's changing in price, creating another format of a pattern, which is what? A falling wedge. Now this correction turns into an impulse. This was an impulse, this was a correction that continued to the upside. That is what's the importance of reading in between the lines. Remember, guys, read in between the lines. That's going to help you to understand the evolving and the emitting of patterns. So that's it for the rising and falling wedge patterns, guys. Let's get deeper to a different pattern. So we're going to be looking at the third patterns, which is a descending and ascending channels. So these ones, guys, are the most high probable patterns to use, or the patterns to look at the markets, because they present the high opportunity of capitalizing from the markets. Guys, these are the most favorite and you must include them in your trading plan. But now let's focus on the nature of them. So the nature of them, they would look like this. So on a descending channel, we will look something of this nature. The market would push to the downside and then correct also to the downside. The reason why these patterns occur to the downside, or corrections occur to the downside, it's because these act as a confirmation for either reversals or continuations. But in this sense is reversals. So the reason why it's a reversal, guys, remember, when prices are about to continue, they literally would correct sideways. But sometimes when the correction occurs going to a structure or approaching the lower side or the upper side, as I'm explaining now, a descending channel, they act as part to tell you that the prices are now oversold right here, because this is a what? This is a descending channel, right? As this is a descending channel, it literally looks something of this nature. This is when we are looking at the bearish market, right? So they would literally push to the downside, right? Correct sideways, actually go into the lower side also. Imagine, how can you push to the downside but also correct to the downside? It's a confirmation of a reversal pattern. This means that the prices have been oversold. Now, looking at the bullish market, it will look something in this nature. The market will push to the upside, correct to the upside, because it's telling us now the prices are literally overbought. So this is why these things occur, or these patterns occur, to tell us that now the market has been overbought, to actually look for what? Reversals. But it depends on what the market is actually approaching with these corrections. Actually, it needs to approach a zone, which is a resistance zone, for you guys to be able to spot that retest, right? And then break out, retest, and continue to the downside. That's on a bullish market. So now let's focus on the real market for these patterns to make sense. As we're looking at USD JPY, so we're going to be able to spot these things, guys. Remember, I told you that there's inner structures, outer structures, etc. So you're going to be able to spot and learn about these things, guys, especially when it comes to the real market. So let's just copy a bit of price and create our outer structure right there to know what we're looking for inside the market. So let's create our outer structure right there and drop it to a lower time frame, which is a 4-hour time frame. So you dropped it to a lower time frame, which is a 4-hour time frame. You're gonna be able to spot these things. As I said, we have what? Ascending channel. So the market will literally correct towards the upside. So let's look closely to the bidder price, right? So let's look right here, guys. It's gonna make sense. So these patterns also have those trapful side about them, but however, they become most high probable if you focus on reading in between the lines. So let's look at this a bit of price right there. So you can see this was what? An ascending channel. As you can see, this was an ascending channel. The market had a push to the upside, but started correcting towards the upside, which retested the previous high, which is our what? Our resistance right there. And then look what happened when it literally reached this level. After breaking out, retesting at this level, it really dropped to the downside. And then it created another ascending channel to form a double top right there and respect the previous high. And then it finally dropped to the lower side. So that's an ascending channel. So a descending channel will look something in this nature. The market had a push to the downside, as you can see, and then it corrected towards the lower side. After it broke out, it came back to retest, and then it shooted up, right? So you can see, let's look closely to what's actually happening. Look at this bidder price right here. Now let's cater for it as if we're looking for a signal. As you can see, we're gonna cater for these. Many touches literally confirm a high probability. So as you can see over here, this was a descending channel which came to retest the support zone, and literally it shooted up. As you can see, boom, it went up and then it came back, right? That's for a descending channel. So let's look at another examples, guys. Remember, the more the examples, the higher understanding you will have. So let's look at the current market right here on what's happening on the current prices. As you can see, we literally had a push to the downside on this price action, boom, to the downside, and then the market started now correcting towards the lower side, which gave us a confirmation of a reversal. That's why the market literally pushed up, corrected, and continued to the upside. That was because it was a falling that was because it was a descending channel. That's why I'm saying these ones, guys, are actually one of the most high probability patterns to trade, because they confirm reversals, right? So let's drop it to a 1 hour time frame. It will make sense. So as you can see, if we cater for these patterns, you're gonna be able to spot that why did these become a high probability trade. So you spot these things, you're gonna be able to see that we formed a descending channel over here. This is a descending channel within a descending channel. As you can see, also over here, we're having a nature of a descending channel to support our descending channel, push to the upside, retest, and continuation. So guys, these are the most important expert factors you need to understand and literally look at. So if we look at the current market price, what's happening right here? It's a what? This is an ascending channel. An ascending channel, as you can see, the outer structure on a 1 hour time frame would be something in this nature. The prices had the first touch, second touch, and the third touch, right? So it had these touches. It confirms to us what you're gonna be looking for, something different. As you can see, if you drop it to a 30 minutes time frame, you're gonna be able to spot that at this current level, we created a nature of an ascending channel, right? This was an ascending channel that literally, when the market broke out of the structure, it literally dropped. That is why, guys, we say these are the most high probable. It only depends on what is approaching. But as you can see, this was a what? A resistant structure. That was why it came to retest and literally dropped. So these ones, guys, are the most high probable. And guys, we literally love these patterns. If you learn and practice them, guys, after this lesson, you need to go backtest these patterns. You're gonna be able to master them. But let's now look at another bit of price. As you can see, we also had our support right here. As you can look closely here, guys, we had a push to the downside, as you can see, but now we corrected sideways to form a descending channel that literally, when the market broke out, we actually continued to the upside. And also here we formed an ascending channel, of which when the market reached the top, we actually dropped. So these guys are the most high probable. An ascending channel occurs in a bullish market to retest a resistance zone or to confirm a double top. A descending channel comes from a bearish market, whereby we would have a push to the downside, correct to the lower side to retest a support zone, break out the structure, retest, and continue to the upside. That is the difference between an ascending channel and a descending channel. An ascending channel is on a bullish market. A descending channel is on a bearish market. So let's go to the next pattern. Pattern number 4. Expanding channels or expanding patterns. So these ones, guys, are also one of the most high probable trades, and literally we can capitalize from them a lot, because this is when the market is now starting to create a bigger picture of a pattern. Do you get what I'm saying? So it's actually that structure that creates a bigger version of a pattern. So the nature of it, they would look like this. On the bearish market, the market will push to the downside and then correct sideways, starting from small prices, expanding to create bigger version of a correction. So they would look in this nature on a bearish market, right? So they will look in this nature on a bearish market. It creates an expanding channel. Remember, expanding, guys, means enlargement of things. So expanding channel is when the prices are creating a bigger version of a pattern. And then on a bullish market, it will look something in this nature. A bullish market, it will push to the upside and then start small and actually create a bigger version of a pattern, of which it's gonna look something of this nature, because it's the nature of it. So the most important thing, guys, is to be able to read in between the lines. So this is one is the bearish market and this is for the bullish market. So the trick side about it is that you can either choose to use a bit of both, in a sense that you can also use market execution and you can also use stops. But in a bigger time frame, we don't prefer using stops or maybe orders. We prefer using executions on smaller time frames. Then on a bigger picture, we actually look at how is the prices moving at the current state. So the most important thing, guys, is that these patterns can either occur on a bigger time frame or a lower time frame. If they occur on a bigger time frame, it becomes a high probability for you to use market execution, because when you drop it to a bit lower time frame, you're going to be able to spot patterns within patterns, of which sometimes they look in this type of nature. So in a bearish market, this will be the push to the downside, as we explained, push to the downside, correction, creating a bigger version of a pattern. But then for continuations, it will literally push to the downside and then correct towards the upside to respect the previous zone in this nature, right? Correct in this nature to create a version to retest the level and create maybe a double top formation on a bearish market. Remember, a bearish market, something like this, we would actually know that reading in between the lines or the key factors of the market, we would know that it will be most high probable to literally wait for the prices to break out of the structure right here, come back to retest before actually going short and capitalizing from this trade, before actually going short to capitalize from this trade in completion of the expanding channel. Because we know the prices immediately they come here, they respect, they come here, they respect, they come here, they respect. So we anticipate that since, well, this is a correction, the prices are also going to respect to confirm a double top formation before actually giving us a clear version of the lower side. So that's the most important key factor to understand on these, especially on the bearish market on an expanding channel. So let's look on how the bullish market would look like. So in a bullish market, the prices would push to the upside and then expand, creating a bigger version of a correction. But then the lower side, now when approached, they will trickle a lot. Trickling means when prices are giving small moves to respect a structure. As you can see, this would be an expanding, because you look closely to it right there, and also we are also supporting there at the lower zone. And then within it, we also have a pattern of which is in this nature. We have a pattern of which is in this nature. As you can see, we would literally wait for the market to actually break out of this structure right here and then give us a clear version of a push to the upside, break out, retest before actually looking for our buying opportunities to capitalize from this trade and then push to the upper zone. Because we have understood that every time prices touches these lines, they literally respect a lot. Every time they retest, they respect a lot. So especially now that we have a double confirmation that we have a support zone which is being respected, and then we have a correction phase that we have been going through when prices were creating a trickling movement where there is no high volatility. Remember guys, on an expanding channel, if it's only impulse moves, that's when you're gonna be able to look for breakouts and actually trade a bigger version of it. But if ever the prices are creating corrections within the expanding channel, you can capitalize from that. But now let's look at the real market for these patterns to make sense. So guys, we're gonna be looking at GBP USD for an example of an expanding channel on a bearish market. So on a bearish market, you can see guys, we're just gonna take prices back from here. As you can see, you're gonna learn how to use this replay button once you have subscribed with TradingView. So let's just cut prices right there and then just come back here. So this is the bigger version. Remember what I said, that on the bigger time frames, it confirms that you can capitalize within those small movements. So if we cater for the outer structure, we can see that this was the resistance, and then below this was the support, right? And below this was the support, right? Let's just take it a bit back right there. This was support. So let's drop it to a 4-hour time frame. If we drop it to a lower time frame, you're gonna see guys, I said the nature of it will have a push to the downside, start small but already creating a bigger version of a pattern. So this was a bigger version of a pattern, but you can see within there we're experiencing what? We're experiencing patterns. This was pattern number 1, which is what? A rising wedge. This was pattern number 2, which is a rising wedge also, and then this was pattern number 3, which is an ascending channel to form and confirm a what? A double top formation. So guys, you're gonna learn to fall in love with the markets once you master these things. So that's why I'm saying you need to backtest, to read in between the lines, right? Sometimes these pairs or these patterns literally help each other for you to create a high probability setup for yourself. So This is an expanding channel. So what's going to happen right here? I'm going to cater for the lower zone right here because we are looking at the current market price, right? As you can see, this as an expanding channel, I wouldn't want to wait for a breakout to break out of this current zone because it's going to be a high risk. Imagine, guys, if I enter this trade and then my stop loss, let me say I enter here and then my stop loss needs to be 300 pips. Guys, we don't trade like that. We have small risk but bigger targets. So in this nature, this is what I'm going to be looking for. This was the first touch, second touch, and now we are waiting for the third touch. Let's play prices bit further. Now the prices literally respected the level. Now it's time to now spot where we're going to put our sell stop. So we're going to say the prices have reached the top, which might be our third touch. So we're going to be looking for a breakout, which means we're going to put our sell stop right here. You know, we're going to put our sell stop right there. But then let's drop it to a 1 hour time frame for it to make sense. So if you drop it to a bit lower time frame, it's going to give us a clear version of where to put our sell stop, because the lower the time frame, the bigger picture or the bigger version you have of the setup you are looking for or the pattern you're looking for. So as you can see, it's patterns within patterns. Also within this expanding channel, we're also experiencing something in nature of an ascending channel. So you can see first touch, second touch, third touch, confirmation, right? And then we're going to say we're waiting for prices to break out this structure, and then we're going to put our stop loss right there to wait for the prices to go a bit lower up until that level. And let's look closely to what's happening. So let's play price. As we played further, you can see the prices are starting to drop quite nicely, right? So it dropped quite, we are triggered in. Now, as you can see, we are triggered in the price. We are having a pattern within a pattern, which is an expanding channel, but within it, we spotted a pattern, which is an ascending channel. Now let's capitalize from it. As you can see, as we play prices, they're starting to respect. They push lower, they keep trickling. Now, this is what we call the rectangle pattern that I've shown you. That, guys, after a breakout, we expect the correction to confirm or create high influence of buyers and sellers to literally tell or push the market towards the anticipated direction. So as you played further, you're going to see it's starting to respect. You see, starting to respect. As you can see, it's creating a bigger version of a correction. But however, we're still within this trade, guys. Imagine you could have held this thing up until when? As you can see, we are profiting from it. Profiting. So when the market has now reached this point, that is when we guys tend to put our stop loss on break even to protect profits, because we don't like taking unnecessary profits to the markets. So it's important to secure your profits and literally put them safe. So we're just gonna play this thing. As you can see, it keeps on playing. We are capitalizing from this trade, guys. Imagine we could have held this and literally profited from it for quite a lot. If you can look closely, how much have we banked right now? Let's just pause the price action. So we could have banked ourselves 1% of, let me see, 1%.12, but our stop loss is on break even. Now let's drop it a bit lower to this zone, right? So now our stop loss is now here, right? Our stop loss is now here. So let's play it further to see what happens. So as you play it further, you're gonna see, guys, we are capitalizing from that trade a lot, because why? We read in between the lines. So when the prices does this again, we're gonna see that this is also a correction, right? And what do we do on corrections? You're gonna learn about scaling in also, guys, how we scale in within the market by reading in between price action. We're gonna also enter the trade right there. I'm gonna also enter the trade right there, have a bit lower risk right there, and then wait for prices to actually play within, right? As we wait for prices, you're gonna see it breaks out. No, it didn't trigger us in. It triggers us in now, and then it continues to go down. You see, guys, we could have capitalized. Imagine we're still holding that trade and also holding this one. So we capitalize from the trade. Now let's go to a bigger version. As we go to the bigger version, you're gonna be able to spot that right here we had our support zone, of which you're expecting prices to reach this level. So let's let's secure profits. We put in our stop loss right here, and then we drop this one right here. Now we have, on the first trade, we have 1%.48, and then on the second trade, we have already secured some bit of profit. And then as we played further, it keeps on playing and respecting our setup. Can you see that, guys? Now, this is how we actually swing trades, by reading in between the lines of expanding. So even on an expanding on a bullish market, it will look something in this sense. The same way as we look at it in a bearish market, they would look the same. So as you can see, this is a clear version of how to trade an expanding channel on a bigger version. But sometimes it actually occurs on small versions, and actually it creates something in this nature. Push to the downside, correction, creating an expanding channel that you just gotta put your sell stop below and put your stop loss above, and then when it breaks out, it triggers you in and you're gone. But that's the nature of them. But if ever it's in a bigger time frame, you gotta be looked to capitalize in between the lines. You gotta look at patterns within patterns. So that is it, guys, for an expanding channel. Now let's look at the next pattern. Hello guys and girls, what's good? This is FX Code, your mentor. Welcome to the FX Code Advanced New Market Strategy. Guys, this one is gonna be one of the bombest that you have ever experienced. So guys, without any further waste of time, let's jump to the true principles of what the strategy implies. The nature theory of the strategy. The market moves in phases. We all know that, right? Impulsive phase and a correction phase. These market phases create higher highs, which is HH, and then create higher lows, which is HL. And also they create lower highs, which is an L and H, and also lower lows, which is L and L. But guys, note something. NB, the market doesn't move impulsively only. There are always corrections within the price movement or volatility. You must practice these phases so that they be registered in your subconscious mind. It's important, guys. They'll be easy for you to apply. That's the nature theory of what the strategy implies about, guys. You need to understand the nature theory about the impulsive moves and the corrections together with the formations or the structures that the market is literally presenting to us. So let's get back to the real markets to show you the true facts about what we mean by the nature theory of the market. Now guys, as we jump deeper into the charts, you can be able to see I'm going to explain quite deeper what we actually mean about the market theory, right? We're going to be looking at Euro USD. So what we mean by the nature of the market is that we know that the market needs to have an impulse move, a correction, which in the nature is forming something like a pattern, and then another push to the upside or neither to the downside. So it's all about understanding the market nature on what it presents, right? So let's look deeper into what's happening at the current state. As you look at this bidder price, let's just copy it from here, right? And then drag it right there, copy it aside, right? As you literally look closer to this, guys, you're gonna see what we spoke about, the market nature. We know after every impulse move, there has to be a correction, an impulse move, a correction, right? So guys, the market becomes more beautiful because we understand that after every push, there's always needs to be an exhaustion. Prices can be overbought or oversold. We only need to understand the market nature that after every impulse move, we need to expect a correction. Corrections are phases whereby the market moves in slight candlesticks, or to say moves sideways, to show that the prices are literally breathing. They're taking a break from their impulse moves. So sometimes it happens that the market corrections confirm continuations or confirm reversals. So that's what we're gonna be dwelling deeper into the strategy. We're gonna be teaching you guys how to read in between the lines by literally understanding the pushes and exhaustions, or to say the impulse move and corrections for continuations or for reversals. So let's focus on the bidder price right here for it to make sense. So as we copy the price aside, you're gonna see something, guys. As you can look, this was an impulse move to the upside, and then this was a correction, as you can see right here. Impulse move, correction, right? So let's cater for that bidder price so that it can make sense. So as you can see, here we had something in nature of a falling wedge, or to say a descending channel. So in other words, we say, as you can see over here at the top also, we're also seeing something in nature of an ascending channel. So these guys are literally patterns that you're going to learn within the strategy as we proceed with the lesson. But however, we just wanted to make sure that, guys, you understand the market theory or the nature of it, that after every impulse move, we need to expect a correction for continuation or either for reversals. So it also happens on a bearish market. So in a bearish market, it happens in this sense. So in a bearish market, the prices would literally push to the downside, correct sideways to really form something in nature of continuations to the downside, or either form something in nature of reversals. So that's the nature of it. We know that, guys, after every push, we need to expect a correction. So corrections in this strategy is one of the most important things that we need to focus on, because that's how we capitalize on the markets, right? The reason why we capitalize on corrections, because you don't want to be caught up on the wrong side of the market, especially entering prices or entering a trade on impulse moves, because that's going to actually trap you on the wrong side of the market. The main goal, it's all about being profitable, but not being a market chaser. So that's it for the market theory, guys. We know push, exhaustion or correction, and then continuation, or maybe push, exhaustion, which is correction, and then reversal, right? So that's what we need to understand. That is how the market nature is presented. So let's get back to the lesson. So guys, now we're going to be focusing on the market structures. Market structures are the overall view of a market direction. We have two types of the market structures, which is the outer structures and also the inner structures. These two types will help you easily read the markets, right? As you know, guys, the outer structure, we're looking at the overall bigger picture of what the market is presenting to us. But the inner structures, we're looking for far most deeper depth of what's actually happening within price action. Let's get to see in the real market what we actually mean. So guys, we're going to be making an example looking at GBP USD, which is pound dollar, right? So in pound dollar, we're going to literally determine the outer structures before we actually determine the inner structures. So in this sense, you need to understand the fact that the outer structures, we're looking at the bigger picture, what needs to be in a weekly time frame or either a daily time frame. What's the bigger picture telling us? Are we on a bearish trend, or neither are we on a bullish trend? So let's cater for the outer structures. So as you can see right here, guys, we have an outer structure on a weekly time frame that has been respected quite a lot, guys. As you can see, this was a trend which was resisting prices. Every time the prices reaches this level, they normally turn. So as you can see also over here, guys, there is some kind of a trickling price action, which means the prices keep moving up, down, without any direction. Whether are we impulsing to the downside, or neither are we impulsing to the lower side, or are we correcting? So by understanding those key factors, this is going to make you understand the importance of literally having the bigger picture before drilling deeper into the lower structures. So as you can see at the top right there, we have an overall structure, which is a resistance, and below it we can cater for here as this would be our outer support, which is a bigger picture, guys. Now the bigger picture of it, as you can see from this current moment, we had an impulse move, correction, right? Impulse move, correction, impulse, correction, impulse. Now the price is formed another pattern within a pattern. You're going to learn about that as we move forward with this lesson, the patterns within patterns. So as you can see, this was an overall pattern, but however, we also have the inner structures, which is the inside patterns we experienced. Now we had a push again, this was an inner structure, we had a push again, and then this was also an inner structure, we had a push, inner structure, the push again, inner structure. So you're going to understand the key factors of this, guys, once we proceed with the lesson quite a lot, because it's going to help you to literally determine the opportunities within this once you understand the bigger picture. Remember, we all normally say that never go against the trend, because the most focus needs to be more on, guys, you need to understand what are you looking for when you enter into a price action. Are you looking for selling opportunities, or neither are you looking for buying opportunities? You wouldn't want to buy on a selling opportunity, or you wouldn't want to sell on a buying opportunity. So that's vice versa. Let's delve deeper into a lower time frame for you to see the inner structures. So we are in a daily time frame right now. So as we made an example, guys, at first, that there's gonna be structures within structures or patterns within patterns. So as you can see, we have an overall bearish triangle right now, which was contracting, squeezing price action within. Now as you can look quite closely here, guys, this was also a pattern within a pattern, right? As you can look right there, remember, the bigger the time frame, the high confluence it has towards your analysis. The high probability, it tells us that, guys, this is literally what's happening within the charts. We need to focus on it and literally profit from it. So as you can see right there, this was an inside structure. But also, if you look closely inside the structure, we have structures within structures within structures. So as you can see, this was a structure right there, which was a pattern in that sense. So we also had a pattern here. And also we had another pattern right there. So guys, the minute you learn these things, you're going to be able to read in between the lines of price action. It's very, very important, guys, that you need to understand these things. Remember, we normally said the market nature says after every push, there's always an exhaustion. So in a weekly time frame, there was a push to the downside, and then this was an exhaustion. But however, within this daily time frame, we also have impulse moves and corrections. So let's go on a 4-hour time frame to break down the daily time frame structures. So as we are in a 4-hour time frame right now, you're going to be literally able to see what's happening within price action. So as I said, guys, within this bit of price that we copied right here, there's going to be patterns within patterns within patterns. So as you can look closely, let's just say, guys, at this bit of price, right? Starting from over here, you're going to see that within this price, there was literally also actions that happened within there. As you can see, we had another ascending channel over here, another ascending channel over here, another ascending channel over here. And guys, like, these things are pretty important. As you saw, the minute it broke out of this structure, it came back to retest, forming a pure, beautiful bullish channel, or a bullish trend, or a bullish pattern, of which you're going to learn from it as the strategy continues. As you see, it literally pushed to the upside far most till that point. So these guys are the key factors you need to understand that will make you high profitable and understand the market nature. You need to understand how the market works for you to be able to know how to read between the lines and be able to take high quality trades. So this is what we need, guys, by structures. So we have the outer structures, and then we have the inner structures. As you know, the outer structures is what happens on a bigger time frame. The inner structures are what happens between lower time frames. So guys, let's get back to the lesson. Impulse and correction phases. An impulse move is one whereby the market moves quite strong or heavily in or on a direction, covering a greater distance in a short period of time. These moves tells you when the imbalance between the buyers and sellers is really strong, and there is a heavy participation from the intuitional side of traders. Logically, they are generally more volatile, and this provides us with great opportunities for more rewards with less risk, since the market will stretch more easily in one direction. But guys, remember this, no matter what, we want to be trading with these moves as much as possible, but let's not go against them. So let's delve deeper into the charts, guys, for you to understand the impulse and corrections. So guys, we're going to be focusing on USD CAD to explain the impulse and correction. So on the bigger picture, this is what we're looking for. This was an impulse move to the downside, and then this was a correction. This was an impulse move, now this was a correction. But guys, within this correction, you can literally see that there were impulses and corrections, impulse, correction, impulse, correction, impulse, correction, impulse, correction, breakout with an impulse, correction. So the minute you understand this market nature, guys, it's pretty simple. Like, you're gonna even laugh with the chart and be like, no bro, you're literally showing me an impulse move and a correction. Then that's when you fall in love with the markets. It's pretty simple. So this was an impulse move. As I said, this was a correction forming a bearish flag in a bigger picture, and then literally dropped to the lower side, forming another pattern right here, literally push to the sideways and impulse to the upside. So let's literally delve deeper into a lower time frame for you to understand. So if you drop it to a bit lower time frame, you're going to be able to see, guys, that sometimes there's what we call trickling. Trickling is literally when the market goes on one side for the longest time. It can be a lot of days, it can be weeks, it can be hours, or neither, it can be minutes. So in this instance, you're going to be able to spot that, guys, this we trickled for quite a lot of times, because this is in a daily time frame, right? As you can see, guys, this was literally, we trickled quite a lot. But within this trickling pattern, you're going to be able to spot that within there, we had patterns within patterns. As you can see, this was a pattern within a pattern. And then also right here, this was also a pattern right here, which was an ascending type of nature. That's why the market literally, when they broke down, literally So up until this point. And then we also had something in nature of a correction right here, of which you're going to understand these things, guys, as we proceed with the strategy. So as you can see right there, so it's this, guys, when you're able to read in between the lines, you're going to be able to profit from the market. So explaining the impulse and correction phase. So this was an impulse, then this was a correction, this was an impulse, this was a correction, right? So you can see it trickled a lot. Impulse, correction, impulse, correction, impulse, then this was a correction, right? Impulse again, correction, now the impulse. So you're going to understand these type of natures, guys, which is going to help you to profit from the markets quite a lot. So taking it to the bidder price, explaining it in a sideways format, you're going to be able to spot that in a white chart, the nature of impulse move looks like this. This is one candlestick or a lot of candlestick pushing harder to the downside, correcting sideways, which forming a correction phase, then impulse again. Or neither, it can look like this, push to the upside, correction, forming something of this nature before actually pushing again. So impulse moves, guys, are literally those big movements that occur within the markets, and then corrections are those small phases that occur where the market has been ranging in between two prices but never breaks out or never exceeds or never decreases. So that's the correction phase. So in the nature of the market, this is how it would look like, right? As we shift it right here, you're going to be able to spot that, guys, here. This is a correction phase right here. As you can see, the market literally pushed harder to the downside, but now this is a correction phase of which the market is now starting to go sideways without any further direction that is giving us. Because if you look closely, this is what we're facing right now. We're having a resistance at the top, and then we're having a support at the lower zone. But however, guys, remember I said the strategy, you're going to learn how to use zones and also use the ray line. I prefer far most the ray line because it works greater with the strategy. So as you can look closely, guys, this is what actually happening right now. So this was an impulse move to the downside. Now it's correcting. That is why it's going sideways. Remember, in this instance, we say at the low we support, at the above we resist. So that's it for impulse move and corrections. Let's dwell deeper to our lesson. Continuing with impulse move and correction. In other words, what we mean by this is, guys, in impulse move and corrections, we have pullbacks or retracement. Is relatively short-term movements of the markets in a direction opposite to the main trend. A correction will be a bearish or a correction will be a bearish in a bullish trend, while in a bearish trend, a correction will be bullish. Corrections emerges as the market gets either overbought or oversold. This can be seen from reading in between the lines of price action. In addition, there is so-called horizontal correction, which also is referred as sideways market range. It takes place when demands for a certain asset or its supply balances each other out, right? So these things, guys, is the pure things that you need to understand, the pure characteristics of what's within impulse and correction. When a correction is over the price return to the initial trend, newbies are often advised not to trade counter the main trend, as such aggressive trading requires experience and psychological resilience. So that's it for impulse and correction. Now, moving to emitting or evolving of trends, basically. This is whereby, guys, you need to understand the importance of not forcing trends. This is whereby you go with the market flow by not forcing trends, catering for the most recent touches and not drawing in between candlesticks. The secret is, as long as it presents two touches, just know it's a high probability. But guys, for it to make sense about what is evolving or emitting trends, let's get deeper to the charts. So guys, as you can see, let's look at it. USD JPY right now will be a pure example to use the evolving type of nature. So evolving doesn't mean, guys, for an instance, let me just make an example. When you draw a trend from here to that point, literally crossing over other candlesticks, guys, it's literally wrong. You need to cater for the most recent touches. If it's two touches, it becomes a high probability. If it's three touches, it confirms to be an area of sensitivity. So making an example covering the overall picture we have, we are actually on USD JPY looking, or maybe we are ranging in between a bearish trend. So in this instance, you need to understand that, guys, catering for the lower zone, we're also looking for something that merges the upper zone, which is what? Our resistance. Now let's drill deeper into what's happening within the outer structure we have built right here on a daily time frame. So on a daily time frame, guys, I'm going to literally show you something that's literally important to understand about the nature of evolving, or to say the nature of emitting price action. So we're going to take a bit of price, just cut it right there, right? So let's look at what's happening currently. Now, guys, this is a replay mode. So in a replay mode, it allows us to literally look at the bigger picture of the market. So literally, we're going to be playing this for quite a lot. So let's drill deeper into what's happening. So overall, guys, as you can see from here, let's just say this is basically a real market. So I wouldn't draw a pattern from here. But however, I'd literally cater these two touches. But however, focus more on what's happening when the prices are literally breaking out. Are we breaking out impulsively or correctively, right? So those are the natures you need to understand. But in this instance, this bit of price right here, we are breaking out correctively. Correctively means what? There's high chance for prices to form another pattern. So as you can look closer to it, this is basically, guys, an inverse head and shoulders. You're going to learn about it as the price, you're going to learn about it as the lesson goes by. As you can see, this was a head and shoulders. Now, we're anticipating price to reach that toppest point, which is this current area, right? As you can see right there, we're looking at head and shoulders. So for me, in this instance, I'll say I'm looking for buying opportunities. What do? I don't just dwell deeper into charts. I need to literally understand what the prices are telling me. Let's go to a 4-hour time frame. As we go on the 4-hour time frame, you're going to be able to spot that we're starting to form a trend. In this instance, a trend would look something of this nature. So we know, guys, that we buy low and then we sell high. But within this pattern, we also having other patterns within. So let's actually look at what the price action would tell us. Remember, we're playing this as if now we're entering a trade. So as we move it forward, you're going to see as we move forward, as we move forward, as we move forward, the prices clearly don't make sense because they are ranging sideways. But however, FX code being FX code, we will be able to spot that this is forming a correction phase. Right? What do we do in a correction phase? We look for opportunities to enter the market. So for us, in this instance, we'll be definitely looking for buying opportunities, right? But we don't use market execution with this strategy. It allows you to wait for prices to come to you. So as we literally delve deeper into what's happening right now, let's play it a bit further for it to make sense. So the prices keep trickling. As you can see, guys, right now we are not yet triggered in. We are not yet triggered in. The prices keep trickling. So this is where now evolving comes in. Instead of drawing this trend line below or above, I'll actually emit the trend line to cater for the most recent touches, which will be the toppest of that point, and also expanding to see if it's creating a different pattern or it's continuing to respect the one that we literally drew. But what do you see? It's literally creating another pattern. So let's wait a second to actually understand the price action. So in this instance, we will literally wait to see what happens. But however, capitalizing from trades, we would look for buying opportunities with the buy stop right there, catering the lower zone, and then looking for far most to go up. Looking far most to go to the upper zone. So let's wait for it. As we continue to play the price, continue to play the price, we are triggered in now. Do you see that, guys? As we are triggered in, we were able to spot that now our first pattern wasn't the correct one. We needed to evolve our trend lines, putting it on the recent touches to ensure that we capitalize from the trade. As we push further, as you can see, prices keep trickling on the lower zone, keep trickling on the upper zone. Now they come back, now they come back. Prices literally keep playing, prices keep playing. As you can see, guys, literally, if the prices reached this level, we could have put our stop loss on break even. That's the most important thing. So we put our stop loss on break even. Stop loss on break even. Now we know when the prices get back, they triggered us into profit. So as you can see, the prices literally come back now. Now we start to what? To evolve again. That's where evolving comes in. So we see the channel is, we see now that the pattern was respected for a short term, but however, in completion of the previous trend or the previous high. Now we evolve. We put our high right there. We put and cater for the recent touches. You see, now as we evolve, we're going to see that this was our first touch, second touch, and this our third touch, respecting a different trend. So as you can look closer to the markets, you're going to be able to spot that. But now we are moving on a different trend. That's the most important thing, guys, about evolving. It teaches you not to force trends. You consistently look at the different charts or to look at different patterns the far most as you go. So the nature of it, looking at in a white chart, is going to be something in this nature. We know after every impulse move, there's a correction, right? Impulse. So what happens when we see a correction? We're going to start now to say the market has established a new trend, right? Which we're going to cater for this trend right there. But as the market corrects within the price action, people are going to anticipate that when the market reaches this point, it needs to buy. But however, you need to be careful. Sometimes the market decides to break the structure or neither respect the structure. But in this instance, talking about evolving, the market decides to push to the downside, push, push, push. What are you going to say? Are you going to say it's a change in price action? Did we break out of the structure? Now we need to look for something different? No. Focus on how the price action is breaking. Are we breaking out impulsively or correctively? In this instance, we are breaking out correctively. This means that we need to evolve our structure to literally cater for the most recent touches. We're going to say from here now to there. So as you see, the market might continue to do so. It's telling us that it's preparing for high buying opportunity and it decides to push up. A lot of people that tend to get trapped in the wrong side of the market because of having a stigma or having fixed mindset of their analysis, saying if it doesn't buy here, then the market doesn't favor me. No, guys, follow the market and never go against it. Let's get back to us. So guys, I hope you understand those are the key factors or the key characteristics of the new advanced FX code strategy. Once we learn this, we're going to be able to spot good opportunities within the markets. Now, let's delve deeper into the patterns that are included on the strategy, what we look for in approach the charts. Guys, make sure to take notes, make sure you understand these patterns, because guys, this is the main key factor of the strategy. What we just learned right now is literally the basics of what's needed for you to trade the strategy. But the patterns are some things you need to know subconsciously, so that every time when you see price action, you're going to be able to say, this is a bullish channel, this is an ascending type nature, this is a bearish channel, this is a descending type nature, this is an expanding channel. Guys, you're going to learn them quite a lot. Fell in love with them. See you on the next episode.
Ladies and gentlemen, I greet you all. Now I'm gonna then move my phone to portrait version. So then I'm gonna zoom in and then start drawing what? Start drawing my diagonal supporting trend line. I've drew it, and then I'm gonna draw my diagonal resisting trend line. Yes, I've drew it again. Then from that point, the second step that then I then move to is what is going to a line graph. On a line graph, that's where I then fix all the mistakes and ensure that everything is what is catered for. So yes, everything is catered for at this time and moment. I know that my trend lines are exactly on point. I then do what? I then move to 4 hours to see on 4 hours if I was drawing a right thing or I was drawing a wrong thing. Then on 4 hours, I have to do some few adjustments. Here I am doing few adjustments, making sure that I cater exactly where my trend line attached what the whole overall structure. So okay, there you have it. So from that, I then move to Japanese candlesticks and check if I have my entries. But I can never have my entries before I do what? Before I draw my levels. So I'm seeing that there is a strong level here, and then there is another one here, Then there's another one here. Another one here. And the final one is there on top. Here's the final one there. So after having my levels, I zoom in, I check whether I'm looking for continuations or I'm looking for the retest before continuations. At this time, I can already spot that I'm looking for continuations, but then I'm seeing that there is another diagonal resisting trend line that I can spot here. I then draw it, and I can see there is another supporting there is another supporting diagonal trend line here. I can literally change the colors to make it easier for our students to see that I'm now on another trend that I deem very important for you to actually know. That's the reason why I have different colors, so that it's going to be much more easier for you to actually analyze in a better way. So now I'm already seeing that the rest of the other trends are not as effective or are not as important as this one. So meaning to say what? My main focus is now gonna be on this one. So I can already see that there is an important zone here, of which I'm gonna highlight right now. So from this important zone, I'm looking forward for reversals going to retest on this other previous zone, and then from there I'm looking for continuations moving further up. But then there is something that is called a point of confluence, of which I want you guys to get to know about that from the strategy. Point of confluence, it's where all my trend lines that I've been drawing, they agree to show me that there are reversals or continuations from that particular point. It forms part of the trends in trends. However, that's where I see that there is a lot of action that takes place from that point at the current situation. That actually helps me to actually do what? To do sniper entries at that time. So here, there is what we call a point of confluence here on this position, because of what? My main trend met up with what? With my trend, which is within a trend. So both of those two trends, they met here. So here there was a high probability for what? For buying opportunities. And also, let me continue to say, there is also a high possibility for what? For selling opportunities at this position here, because I see that there is something that is called a point of confluence. That's where the main activity that was taking place at this point here, also we are expecting it to actually take place here. That's why I'm saying I'm expecting a reversal from this point, not a continuation, because I'm expecting it to actually do what? To go down when it gets to this point and then continue moving forward. Ladies and gentlemen, I'd like to take this opportunity to greet you all and welcome you to the 10 steps that you follow every time when you analyze. So these are the FX Go 10 steps that you need to follow every time when you analyze. Without wasting any of your time, let me start with the first step. So the first step is that you move from whatever time frame that you were in to a daily time frame. Whichever time frame that you were in before you logged into your MetaTrader 4 is not important. You then start by actually doing what? By moving to a daily time frame. The second step that you then follow is that you move your cell phone to a portrait orientation so that everything appears clearly. What is a portrait orientation? It's that horizontal way of seeing like your cell phone in a horizontal manner. The screen becomes like much more bigger and better and easier for you to actually utilize. The third step that you then follow, you look for an overall direction. Remember, you're now in portrait orientation. You look for an overall direction, whether it was the buys or the sells. You then decide whether you are looking for bullish or bearish opportunities. Number 4, you start drawing your diagonal supporting trend line and your diagonal resisting trend line. And then the 5th step that you then follow, you move from using Japanese candlesticks to using a line chart. Number 6, you fix your trend lines and make sure that everything is catered for. Number 7, you move to H4 from day 1. You remember you were on D1, now you move to H4 to do adjustments again and to ensure that everything is catered for. You do these adjustments again and then you move to Japanese candlesticks again to start looking for entries. When you are now on step number 7 on 4 hours, that's where you start looking for entries. Which entries am I gonna be taking? On number 8, you then draw your levels or zones or your horizontal support trend line and start your resisting trend line. Number 8, you then draw your levels or your zone. Your zones are your so-called horizontal supporting trend line and your resisting horizontal trend lines. So those are your levels, which are then your zones that you then start drawing. Number 9, you decide whether you found your entries or not. If you haven't, you then move to a smaller time frame, which is smaller than 4 hours. It can be H1, M30 to M15. Your H1 means what? 1 hour, 30 minutes, as well as 15 minutes. You then decide whether you have found your entries. If not, you then move to a smaller time frame, which is smaller than 4 hours. It can be H1, which means 1 hour, M30, which means 30 minutes, or 15 minutes. Number 10, you then move to a smaller time frame to decide where is your stop loss and your take profits.